in the eyes of investors, you have a lot of confidence that we've slayed the inflation boogeyman.
I think people have been too negative all year about U.S. economic growth.
The retail trade is still on in full force.
The Fed is going to be able to pause, and it's going to be a function of this inflation data coming down.
What markets are looking to now is what's going to happen in 2024, and it's not going to be 2023 where we see revenue growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market slightly positive on the S&P 500 this hour. Earnings from Bank of America. In the next hour, you'll hear from Morgan Stanley. But so far, so good for an equity market sitting at highs we haven't seen since April of last year. The commentary from the bears sounds a little like this now. Marko Kolanovic over at JP Morgan. A narrow path to a soft landing, modestly wider. This from Jan Hatzius of Goldman Sachs. They've got better confidence that, quote, bringing inflation down to an acceptable level, Tom, will not require a recession. You've seen commentary after commentary from the South side sounding a lot like that over the last 24 hours.
Yeah, and from the South side, Janet Yellen with our Anne-Marie Horton saying pretty much the same thing, granted with the policy prescription as a public official. I agree the Hatzius news is important, and it's, what I'm calling, folks, rationalization Tuesday is everybody, particularly bears, not Hatzius as a bear, but the bears are rationalizing where they're going. But far more important to me, John, witnessed the Wall Street Journal article this morning, is this partition I've never seen before between these big banks today and in the morning, and also the little banks coming on, the little banks like PNC of Pittsburgh and also Western, whatever it is out in California.
Western Alliance.
Nailed it. Thank you.
Yeah, okay. Lots of regionals reporting, lots of major banks reporting as well. Goldman Sachs coming up tomorrow, and some data out there too. Lisa, 8:30 Eastern time this morning. US retail sales, that's going to be a focus as well.
Especially because the expectation is a softening in the discretionary spending. It's supposed to be dominated by some of the more base effects. And one thing that we have forgotten about is, as things have gotten more expensive, people have been more discerning about where they spend their money. So everyone was flying everywhere, but they might not have been buying the expensive Cartier watches, which is the reason why Richemont was having trouble. So perhaps these are some of the trade-offs that people are making, although I'm not saying.
Cruises and not watches, Tom. Cruises and not watches.
I read about it. I don't know. Dana Telsey wrote up Louis Vuitton and said, they're pretty good except for the United States. I mean, I read every word of Telsey's note.
You saw that in Richemont too, a bit softer here in America.
Yeah, a bit softer here in America. And why should we be surprised? And is that okay? And these extremely expensive stocks, I guess they pull back, 5-8%?
Well, but the issue is it's not even just China. And I think that really is what we should underscore. With Richemont, it was this belief in what would happen on the heels of China.
John,
but what we're seeing right now is that in the U.S., we are seeing people pull back on certain spending that is discretionary. And we're seeing that across all different income levels. Do we see some sort of reiteration of that today?
There are some trade-offs we need to talk about. Let's talk about equity futures right now on the S&P 500. Barely positive in the last 10 minutes. Just about positive right now by 0.03%. Yields are down again by 5 basis points, 375.40 on a 10-year. Let's sit on the ECB for a moment. Even the ECB hawks don't want to commit to a hike beyond July. TK, I think there's a message in a bottle there over in Europe.
It's a different story, and for Lagarde, a different story, and it is the politics of Europe as well. But I agree, John, that's beneath the radar today. I guess it moved the German market a little bit, the German bond market, the depth of Europe. But I agree. And also note, I just looked down here. I haven't looked at least since I walked in the door 10 minutes ago. The 10-year real yield in the United States has just plunged, and I use that word specifically, to 1.5044. A 149 on the 10-year real yield is the same as that verbiage out of ECB.
Push it through foreign exchange. Still, some euro strength. We grind out another one. Let's just sit on this for a second. The euro against the dollar, positive, stronger for 9 consecutive sessions. We close here, right now. That's the longest streak going back to 2004, Bramo. Euro dollar right now, 112.50.
Which is fascinating, because if you have a dovish tone from the ECB, the fact that there is still euro strength suggests something deeper and perhaps stickier. Today, the bank earnings that we were just talking about, John mentioned Bank of America around 6:45 and Morgan Stanley around 7:30. The analyst calls 8:30 and 9:30 a.m. respectively. PNC, Tom mentioned this, they're set to report at 6:30 8:30 a.m. Western Alliance after the bell. What I am watching is just which are the winners. JP Morgan, the clear winner year to date with about a 17% gain. Morgan Stanley with about a 3% gain. Bank of America year to date down about 9%. Today, the G20 finance ministers and central bank governors continue their talks in India, talking about the ECB. Klaus Knott over the past couple of hours talked about perhaps July will be the last rate hike for the ECB. A very different tone than just weeks ago, which is what you were alluding to, and giving some support to the European bond market. 8:30 a.m. U.S. retail sales. I am watching how much higher gasoline prices, albeit not that significantly, but just a touch based on a month-over-month comparison, and the fact that you are seeing increased sales in certain non-discretionary areas, how much that's offsetting the underlying fundamental dynamism behind some of the sales.
Lisa, thank you. Packed day ahead for you. The week really picks up this Tuesday morning. Joining us is John Stolfus, the Chief Investment Strategist at Oppenheimer Asset Management. Is the path to a soft landing a lot wider, John, after last week?
It certainly would appear so, Jonathan. When we think of all the capitulation that has happened in many spots across the board from the bears, it looks as a recognition that the Fed is doing the job. The consumer is showing up, even though they've curtailed spending somewhat. And business is being remarkably resilient, whether it's the cost cutting in technology or in other areas. It's remarkable. Everybody seems to be doing a good job at working through what could be a fairly tough transition that's coming out a lot better than had been expected.
John, what's interesting here is not the when of it. I'm going to suggest that you had to struggle through 22 with optimism that was difficult to find, and now you've hit a home run clearly on a bull market. I'm seeing the bears rationalize. How do the bulls like you rationalize now? How do you reframe from 4X00 up to SPX 5000?
Yeah, we have to stay humble. We have to realize that, in the 40 years that I've been in this business, I've learned one thing: just about anything can happen without enumerating all the things that have happened. We're just thinking of all the different crises that have happened, all the difference in terms of innovations that have changed the structure of economics and doing business, the political structures that have come and gone and returned. It's an extraordinarily challenging period. But it does look for now that, business is doing well. Businesses are not deer caught in the headlights, but yet with advanced technology able to navigate challenging waters. We're beginning to see that in this earnings season, knocking on wood, and hopefully we'll continue to on that. But the Fed and central banks around the world, whether it's the ECB or the BOE, have been remarkably sensitive in recognizing the effects of their actions from past periods. And that, combined with a lot of liquidity around the world still out there from fiscal stimulus, is helping float this recovery process.
Well, how do you decide then, John, when to take some chips off the table, when to get a little bit more, not defensive, but at least cash in, given that everybody's joined your party and you've gotten much higher in terms of valuations than we were 6 months ago?
Well, Elisa, there's a couple of things. I think when we look at this, if we all look back and we think, are most things that we buy more expensive today than they were a few years ago? Yeah, they sure are, except for stocks on a broad basis. And the rallies that we have seen in technology and all still have not taken the S&P. Last I looked, the S&P 500 was still down around 5.5% from where it ended 2021. And many of the sectors were much worse off. So it would look there's a lot more recovery still to happen here. The other thing is, I think an investor has to know, are we traders or are we intermediate to longer term investors? And the intermediate to longer term picture still looks decidedly, if not rosy, it looks healthy for a market to climb a wall of worry. But we're not big on memes. We don't like the memes. We're not big on cryptocurrency, but we like good companies, positive cash flow, profitability, and managements and products that attract investors to them. We like tech, we like industrials, consumer discretionary, and the big bank financials look good to us as we begin moving towards, we believe, what will be a more normalized yield curve.
And we'll get a sense from the big banks coming up, the latest with Morgan Stanley and Bank of America. You mentioned big tech, and I know you are still very bullish on big tech. A lot of people say they want to bet on AI, looking at the companies they're going to benefit more peripherally. What makes you want to double down on the biggest, most popular of the technology giants?
I don't know if I'd say double down, but definitely want, we're not running away from it. It's the innovation that technology offers today benefits all 11 sectors, not just itself. When I got into this business, if you talk technology, it was business, government, and education that used technology mainly. But today it's deeply embedded in the lives of business, the consumers, and those other groups as well. We're all tied to the upgrade cycle. And while their risks increase in terms of privacy and all kinds of issues that need to be addressed, technology has really brought us to a most remarkable point today in providing a resilience that we believe is reflected in the market. So that's why we still like tech. However, that said, if you look at our weekly piece, even though we rate technology outperform for the S&P 500, we're somewhat underweight versus the benchmark. I can't believe it. I think when I looked at it over the weekend, it's close to 28%. We're at 26 or something like that.
Right.
But for most people, they have to really judge what their exposure will be. But think of all the sectors like industrials that are positively affected going forward in terms of innovation and all that's happening within chip onshoring or the business of infrastructure build and around the world.
Right. John, you're very top down. And most of the people surveillance talks to are all top down. I want you to talk about the heritage of bottoms up among the security analysis of OPCO. And I'm going to go back to the giant Myron Picot, who we all worshipped and read every damn word of on the Insurance Act. What's the value right now of reading bottoms up security analysis to rationalize your top down belief?
Well, I think the important thing is to recognize valuations relative to where they have been historically, not just in recent history, but longer term, and then compare it to periods where you had extraordinary innovation, and then to recognize how an analysis has been affected by technology. I can remember years ago when I was at Mike Wilson's firm. I used to work at that firm without mentioning the competitor. At that time, I was working at 1585 Broadway, if you know the address.
Give us the zip code. We need the zip code.
The technical analysts there at one point were still putting up large pieces of paper on glass windows that surrounded their offices to draw up their charts. Today, everything is instantaneous. You can put things together, back test, forward analysis. And technology has made a very big difference in terms of Wall Street. And it's reflected, I believe, in the resilience that's shown from maximum drawdowns. If you do the comparisons from the 1970s into the 1990s to today, it's fairly remarkable, and it affects the way the Federal Reserve operates, but it most certainly affects the way corporations respond to situations. And we think when trouble shows up, it's the quick response that makes the difference. It doesn't mean the quick response will be correct, but the quick response can often, it's the first response, and then you keep tweaking it until you get it right.
John, we can do it together. Therapy session. Morgan Stanley.
Let's
we can say it.
Let's get Mike Wilson, John Stolfus together.
Morgan Stanley. John, thank you, buddy. It's good to catch up.
John, congratulations, John.
Of Oppenheimer. Difficult year last year for John. Much better year in 2023. He's been confident this equity market would perform. This stock market so far this year has performed.
I want to go back to 2 to 4 second quarter. Lawrence McDonald writing up in his Bear Trap report, he talked about the great hijacking that is out there. And that's what we're coming up on in these tech earnings. What will the hijacking stocks do?
Well, the bulls have hijacked the narrative big time.
Yeah. What's this hijacking going to look like into August?
Next hour, Amy Wu Silverman of RBC from New York City. Good morning.
Growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think that we're on a good path to bringing inflation down. The most recent inflation data were quite encouraging, that we're making progress on getting inflation down.
Janet Yellen on the conversation at the moment, validating the soft landing hopes and dreams. The Treasury Secretary catching up with Bloomberg's Anne-Marie in the last 24 hours. We'll touch base with AMH in about an hour from now. Jan Hatzius at Goldman Sachs making a move. We're cutting our probability that a US recession will start in the next 12 months, further from 25% down to about 20%. The main reason for our cut is that the recent data have reinforced our confidence that bringing inflation down to what they call an acceptable level will not require a recession. Heard something similar from Seth Carpenter over at Morgan Stanley, Tom, and certainly the equity market bulls so far this year feeling validated by the data of the last week. Let's see if it continues through this summer and beyond.
I go to retail sales at 8:30, John. I think it's really important. These are reported nominal. So if inflation's coming down, maybe retail sales are in some way a little bit light and coming down, and that's the indication that we heard from the secretary in that interview with Anne-Marie. But there's got to be a numerous set of indicators to say that inflation's coming down, and they accumulate, is how I'd put it. That's all there is to it. Joining us now to synthesize the moment is Kit Jukes. He's Chief Foreign Exchange Strategist at Societe Generale. He writes, John, what would you say, 2 paragraphs?
No, 3.
I mean,
he writes 3.
Is the tea even steeped before he's done
3
writing?
paragraphs, Tom.
Kit Jukes joins us now, the king of the 3-paragraph morning note. Is it hard to keep it concise right now, Kit? Are you overwhelmed by complexity as identified by the foreign exchange market, or is it a simple story?
It's quite complicated, but in a sense it's simple. You have to keep it simple. It's simple because everybody has taken a few pieces of economic data in a very confusing world and has latched onto this soft landing story and is embracing it, and they're selling the dollar, which has gone up a long way, and they're buying everything else back, except for the Chinese yuan, which they can see the problems with. And that's kind of what they're doing across the board. So we've got a simple reaction that's replaced what we've been doing all year, which was just trading foreign exchange off the next interest rate decision by the Fed, the ECB, and Bank of Japan, and whoever. But we are going all in pretty quickly on this soft landing.
The soft landing identifies to a weaker dollar. Can you suggest that you can get big figure moves out of any given pair, out of DXY as a traditional index, out of the Bloomberg Dollar Index, BBDXY? Is it a big figure scope, or are the compensating factors so real that it's a sort of a nudge along a line into 2024?
I think we can go back. I would think that we will struggle to get the DXY to fall by another 5% from here, but it could fall the best part of that. We could go back quite easily to close to the kind of lows we saw at the end of 2021 when the Fed had been really accommodative and we hadn't started talking about the Ukraine war or talking much about policy normalization. We could go back to those levels. In other words, where we were when we were recovering from COVID, but weren't talking about Ukraine.
There was an interesting test this morning. Some people speculating that the reason for the euro strength and the dollar weakness was because the ECB was much more hawkish. This morning, it seems like there is a decidedly a more dovish tone out of ECB members, with Governing Council member Klaus Knott saying, for July, a rate hike, I think it is a necessity. For anything beyond July, it would be at most a possibility, but by no means a certainty, a very different kind of tone. Are you saying even if the ECB stops raising rates past this month, we will still see euro strength and dollar weakness?
We should do. There's one caveat on that. What we've got at the moment is a market that's pretty optimistic about how the US economy is looking and still pretty pessimistic about the way that the European economy looks. So we need the European data at a bare minimum not to get worse, but preferably to continue looking as if we're going down a path towards economic recovery and not over-embrace this kind of story of Europe's in a mess and the US is all good, because that could push us further. I think, whether the ECB's finished or not, I suspect, it's a big council. There's got a lot of speakers. You haven't heard from Lagarde for a few days. We'll get both sides of that argument as we go along before we're done. But yes, the euro can go up just on a rethink of some of the negativity around the European economy.
I love that. We're sort of at the day-to-day kind of level, that because we haven't heard from Christine Lagarde for a couple of days, suddenly that means that perhaps something might have changed in the past couple of days, John. I mean, that's sort of what the implication is that every day is a new message.
I felt like that was a subtle dig at the ECB president then, Tom, about the frequency at which she speaks. Kit, going beyond September, let's just go back over the last 12 months. I never expected them to get to 4% on rates at the ECB. Did you?
No, we've all gone. I mean, these aren't. We're old enough that these aren't historically high levels, but we have gone up quickly everywhere. I think that's the piece you would say. Further, I didn't expect to get to where we're ever going to get to in the UK either. But that tells you that we're trying. It tells you the strength of the global economic recovery, thanks to the monetary accommodation and even more the fiscal accommodation we got in the last couple of years. The global economy came out of the pandemic with a lot of momentum coming through to it. A lot of people had a lot of places to go, a lot of planes to catch, a lot of beers to drink, a lot of parties to have. And we got out and we got on with it. And that got its own momentum. And in a sense, that's both the danger and the positive. That gives us momentum. The danger is, we're spending pent-up demand. We're spending for what we missed. And one day we'll run out of desire to do so, and we'll run out of money. And then we'll have to see how soft the landing is.
Kit Juice, SocGen. Kit, thank you, buddy, as always. I remember Chris Harvey of Wells Fargo calling it spring break for adults coming out of the pandemic. And Tom, if you look at what's happening with the airlines and what's happening with the cruise lines, it still feels like spring break for adults.
But again, it's Rationalization Tuesday here. And just to point out here, someone like Chris Harvey has been incredibly supple, adaptable, amendable week to week. And the people that are rigid right now, both long, both short, whatever the belief, they're the ones suffering. I give the highest marks to someone like Chris Harvey. Luke Kawa, too, has been that way.
Luke's very cool. City.
Well, he's okay. He's not cool, but with a dog like that. I mean, his dog is cool. He's not.
Okay, that's the assessment on Kawa done. Yeah. City, as I was saying, out with the pushback on the SAF landing optimism. Veronica Clark's going to join us very quickly. The team with Andrew Hollenhorst saying that optimism might be premature, that inflation could well reaccelerate going into the end of the year and coming out of 2024. I just wonder how useful that call is right now for anyone who wants to put on the trade, because in the words of Mohammed Al-Arian on Friday, this is a narrative at the moment that he doesn't think you want to fight, Tom, in the equity market, cross-asset for that matter, because so many people are on board with this idea that we can land this plane softly and avoid a recession.
Yeah, no question, to get to where Hollenhorst and Victoria are, the only way to get there is data. And if the data swings the other way, I mean, that would be stunning given the glow that's out there right now. It's
more data in about 2 hours and 5 minutes. Look out for that. US retail sales just around the corner. Claims as always later this week. The data's pretty light this week. Light on the Fed speak. You won't get any. As we said a few times in the last day or so, it's the quiet period for the Federal Reserve ahead of their meeting this time next week, their decision a week tomorrow. All the earnings you get through this morning. Bank of America a little bit later this hour. Should come in about 20 minutes time. Then it's on to Morgan Stanley in the next 60 minutes or so. Then after that, you get Goldman Sachs on Wednesday. Goldman Sachs over the last couple of weeks just feels like the South Side.
What a mess.
Media commentary has set the bar so low going into earnings from David Solomon and the team. This is what equities look like going into those results from MS, from B of A a little bit later. Equities totally unchanged on the S&P 500. Talked a lot about the ECB with Kit. That sparked a bond market rally in Europe. It carries over to the Treasury market. Yields are lower by 4 or 5 basis points. Your 10-year, 375.79. And there it is again. For a 9th time, the euro stronger against the US dollar. Really interesting 2 hours coming up on Wall Street. Bank of America results just around the corner, then Morgan Stanley, and then US retail sales. Going into all of that, equity futures on the S&P 500 pretty much unchanged through most of this morning over the last couple of hours. We're negative now by 0.03%. We're down about 0.1% on the Nasdaq 100, which has outperformed massively to the upside year to date so far. Into the bond market, 2-year, 10-year, 30-year, shaping up as follows. We're down 5 basis points on a 2-year to 469.37. 3.7. We're down about 4 or 5 basis points on a 10-year as well, 375.99. The bond bulls can thank Europe this morning. Couple of ECB officials not exactly endorsing a rate hike beyond July. And if the most hawkish officials on the ECB aren't committed to a hike beyond July, you wonder who is on the Governing Council. In the euro, though, it doesn't seem to matter. Nothing does over the last 9 sessions. 9 consecutive days of euro strength. It continues. The longest streak going back to 2004. Tom, the euro, 112.51.
It's impressive, and it's a pulsating thing. It's out to 4 decimal points to the right. I mean, it's a very, very subtle thing, but you're correct to identify this. And I would go across to us to a 10-year real yield of 1.51%. The same thing, the inflation or disinflation metric there, just pulsating a little bit lower.
The last week dominated by optimism about soft landings, encouraged by the recent economic data out of America. You heard that from Jan Hatzius and Goldman. You even got a glimmer of that out of the investment bank over at JP Morgan. But this is what Veronica Clark and the team have got to say over at Citi. Optimism around a soft landing is premature. Tight labour markets, elevated wages, upside risk to shelter and other services inflation means we do not share this optimism. Tom, absent a tightening of financial conditions, inflation may well re-accelerate in early next year.
Without question, the interview of the day for the present in new bulls. Veronica Clark is economist at Citigroup, working with Mr. Hollenhorst. Without question, they have been out front on market economics and looking for higher rates. Veronica Clark, let's cut to the chase. There's a new soft landing-ish out there. What do they get wrong? What is the singular distinction which allows you not to join the club?
Yeah, I think it really comes down to the labor market, and the data that we might see for the next, really for the rest of this year could look like a soft landing. We will probably get still some strong activity data. Inflation, especially by CPI, could look like it's slowing. But unless we get more loosening in the labor market, it's hard for us to see that inflation, durably, sustainably comes back to 2%.
What is the employment data that matters, and do we have to wait for the first Friday or whatever of August to get a recalibration here of which way this landing goes?
Yeah, it ultimately comes down to what wage growth does, really. But all the employment data is going to matter, of course. And when we have a very low unemployment rate and we're still adding, over 100,000, well over 100,000 jobs, that's still putting, downward pressure on the unemployment rate. That should mean that there's still that upward pressure on wages. And we'll be watching, the ECI that we're going to get next week. The Atlanta Fed has a wage tracker that is also still showing wage growth that's too strong to be consistent with 2% inflation.
Some people are saying that the reason why inflation is coming down so quickly is just because the year-over-year comparison numbers are so easy to beat. Can you give us a sense of which aspects of the inflation read could potentially regroup and reaccelerate in the next 6 months?
Yeah. I mean, that's definitely part of it, especially when we're looking at headline inflation and energy prices that have come down a lot. We will still see, falling used car prices probably in the next couple months. And of course, that's been a really strong component of inflation, and that will look a lot better. But components that we're focused on are still those core non-shelter services, shelter, which should continue to slow also. But even something like that is where we could see some reacceleration. We've already seen this rebound in housing activity. So we might see some of that upside later in this year and maybe early next year.
Our colleagues just caught up with Janet Yellen again, the Treasury Secretary, in an interview over in India. This is what she had to say, that the intensity of hiring in the United States, those demands have subsided. Just on the disinflationary dynamics in the United States, she detailed a range of them, citing the labor market, housing costs, used car prices, every reason to see housing inflation impulse dropping from here. Now, Veronica, just on one of the points that Secretary Yellen made, just on the labor market, this is still the debate. Has been the debate over the last 12 months. Can we get inflation back to a so-called acceptable level, something on its way back to 2%, without significant softening in the labour market, which basically means can we achieve that without sending unemployment much higher than where it is right now? Veronica, do you think that's achievable?
Yeah, I mean, some of the data that we've had over the last year, it certainly looks like that could be a possibility, but I would still be pretty skeptical of that. We've had job openings that have come off their highs, but there's still about 3 million more job openings than there were pre-pandemic, and fewer unemployed people to hire. And we've had the quit rate that came down back to normal levels, but has actually ticked back up again. And of course, it comes down to wage growth, and that is still running, 5-6% or so, and that's still too strong to be consistent with 2% inflation.
Do you think that at this point, given the fact that a lot of the disinflation that we're seeing is a result of simply year-over-year comparisons and not necessarily Fed policy transmitting, are bets of a soft landing at this point, in your view, the same as bets on immaculate disinflation?
Yeah, a little bit. That is, the ideal soft landing scenario for the Fed. We get maybe softer growth, but inflation comes down without this bigger contraction in activity. And I would really be cautious, especially around what we've seen in the housing market, where that is the most rate sensitive sector. And we did get activity slowing. We did get prices coming down some, but that drag from monetary policy seems to have come and gone. And we've gotten this rebound in housing and prices have started to pick up again. So that could be somewhat of a cautionary tale as we're getting into next year.
Veronica, I'm going to go to where the Cincinnati Reds are. They're the most exciting team in baseball right now. So let's move to Ohio. The unemployment rate is 3.6%. Before the great financial crisis, it was 5.2, even 5.5% as well. Are you suggesting this is a Fed that wants to drive the Ohio unemployment rate back up above 5%?
No, they certainly don't want to, see a rising.
How can they have it both ways then? I don't get
basically.
this. I don't get the. I totally take your answer, but then how can you do what they want to accomplish?
I know. I mean, the Fed has acknowledged, of course, that maybe the labor market does need to loosen more. Their own forecast for unemployment rate at the end of this year is higher than we are now. It's about 4.1%. Obviously, they would prefer to not have a big contraction, but ultimately it has to come down to what does it take to get inflation lower, sustainably back to 2%, and ultimately that might need to be more loosening of the labor market.
The loosening of the labor market, doesn't that equate to higher unemployment rate?
Yeah, and that's the Fed's own forecast too. They do have a bit higher unemployment rate than we have now. It does become a question, how high will they be willing to tolerate, and maybe we'll see as we get there. But the next 6 months, I mean, they might look like they're on this ideal path to soft landing. It just might not be sustainable.
I was just reading through some of the comments that John was talking about with Janet Yellen speaking with our colleagues over in India again, and she's talking about some of the features that need to happen in order to keep inflation on this downward path. And she points to profit margins in a much more diplomatic way than Lael Brainard does. But she says profit margins are also quite high, and they have some cyclical dimension. So I don't want to go so far as to say you couldn't see inflation come down without further moderation in wages. Lael Brainard earlier said the companies need to bring the markups down. How much is this a feature of why inflation has been sticky?
I mean, I think in general, I mean, if we are getting this slowing in activity, you probably will see profit margins come down, and that is related to slowing of demand that will bring inflation down. I think it's maybe one of many components, but we might see some of that contraction if we do get inflation lower.
So, what's the most mispriced aspect of the inflation path in markets right now, from your vantage point?
I think really as we're getting into next year, the next 6 months, we probably are, we're expecting inflation to come down, especially if you're looking at CPI inflation. But maybe, the durability of that for next year is still a little bit, overappreciated. People are thinking that we'll get to something like 2% inflation and it will stay there. But I would be much more concerned about scenarios where, shelter prices are picking up again. Even a tight labor market, that means wage growth is stronger, and that could mean just general inflation is stronger for next year and maybe even beyond.
What is the Citigroup call right now on this present quarter of real GDP? I'm getting 2-ish. I guess I'm below 2-ish, but I'm edging towards, everything's an ish now, John. 2-ish. Are we near 2-ish?
We're near 2-ish, yeah, right around there, and we've been there for a couple quarters. Of course, 2%, real GDP growth is still pretty strong. That's not looking like even a soft landing. That's not even looking like just below potential growth. That's still activity that is still pretty strong.
Hey, Veronica, love the pushback, I've got to say. Keeps things interesting. Veronica Clark there of Citi, pushing against the soft landing crew of the last week or so following inflation data in America just in the past week, and looking ahead to 2024 and potentially anticipating a re-acceleration of inflation. That would change the debate on Wall Street, that's for sure. This morning, the focus is elsewhere. It's firmly on the banks. A little bit later this morning, in around about 5 minutes from now, we should hear from Bank of America, then on to Morgan Stanley. Then tomorrow, you'll hear from Goldman Sachs. In between, tons of smaller banks, so-called regional banks here in the United States, reporting. Just moments ago, PNC. Alongside us, Shonali Basak, Bloomberg Wall Street correspondent. Shonali, good to see you. Good morning. Should we start with PNC this morning? What have we got?
We sure should, because you're seeing some of the macro challenges the banks are facing floating into PNC. Because even though net interest income is slightly above expectations there, and charge-offs are actually below expectations, you're still seeing revenue overall come in slightly light, and you're also seeing their expenses, their efficiency ratio, come in slightly high. So again, this is kind of one of the bigger of that mid-sized group here. They are going to be more bellwether for the challenges that the rest of the group face.
I'm sure, Shonali, in their wonderfully clear statement here, net interest income declined 2%, net interest margin, NIM decreased 5 basis points as well. To someone like you, does that mean right-sizing right away? I mean, is PNC with a flattish story here, and maybe we'll see others like Western Alliance more challenged, does that mean the only one thing you can do is to cut costs?
Yes. I mean, how you cut costs is going to be of critical interest. Remember, costs are rising across the board in many ways, personnel being one of those ways. We've seen a lot of the pressure so far in the job cuts be in mortgage units so far, as well as investment banking. For PNC, what do you do when it comes to more personal bankers here, people who are dealing with more of the American society? By comparison, Tom, JP Morgan's net interest income for the first 6 months of the year rose 25%. Citigroup's rose almost 20%. So that's the difference between being the biggest of the big and being in the middle of the pack.
And just to put a bow on that, PNC Financial sees third quarter net interest income of about 3 to 4%. So just compare the two numbers, completely different ballpark. We're also seeing that the average loans in the third quarter were down about 1%. PNC was considered the most strong and the best positioned of the regionals. What does this suggest about some of the smaller, less well-positioned firms?
Well, this is the problem, because you're seeing the small and medium-sized lending, and you've seen this in the Fed data, so it shouldn't surprise anyone so much. It's now granular bank by bank, but loan demand isn't booming on its own. The businesses we've been talking about, it's credit card businesses that you're seeing a lot of money being borrowed from the banks. So it's not the kind of texture of loan that you're seeing from a bank like PNC per se.
What are you looking for? Is it going to be the issue of cost of capital for some of these firms? Is it going to be loan demand, or is it going to be a lack of competitiveness at a time when the big banks still have much more capital and much cheaper capital at that?
It's all of the above. And remember, the long-term structural challenges they face. We have the Basel III Endgame kind of release coming out next week on what that looks like. And banks like PNC all of a sudden become more under the surface when it comes to stricter regulation. That's a cost. Ultimately, that's a cost.
Let's set up the next 60 minutes. The next 3 minutes, we get Bank of America in just a moment. Morgan Stanley a little bit later this morning. You're catching up with James Gorman at 1:30. We're all looking forward to that conversation. Let's start with B of A, which just drops right now. EPS at 88 cents. That's just come through. Net interest income, 14.29 billion. The estimate, 14.3 billion. Shonali's going to dig through this. We were talking about loans just a moment ago. 1.05 trillion. The estimate, 1.05 trillion. That bang in line. For anyone who's interested in equity trading revenue, that comes in at 1.62 billion. The estimate, 1.54 billion. Provision for credit losses in at $1.13 billion. FICC trading revenue, 2.76 billion. The estimate, 2.44. The stock is up in early trading by 1.6%. Shonali, you've had about 60 seconds, so go ahead.
Deep into it.
Well, there are a few things here that I want to cut right through. One is that their trading revenue is very impressive, right? I mean, they have a significant beat there, both on the equity side and a strong fixed income as well. We want to see those institutional businesses really be kind of the balance here for Bank of America when you start to think about other businesses. We also have provisions coming in line with expectations. Something Bank of America has not done yet is given those expectations for net interest income figures for the year, as we've seen the other banks not only do but raise. So it's not going to be an easy comparison to make when you think about what their full year expectation might be. They haven't given one yet. Interestingly, I think this is very, very important. The non-interest expenses came in above expectations. And so remember, Bank of America has long been an expense management story. Are investors going to be okay with that figure? I would also say they had a regulatory action that was recently announced as well. So
I'm afraid to ask, what's a regulatory action? Someone didn't do the dishes.
The CFPB, the OCC, they didn't like what was happening there. They accused Bank of America of some illegal practices when it came to overcharging on fees and when it came to handling certain customers.
Their PowerPoint deck of 37 pages is different than the JP Morgan Power deck of 39 pages. This has Moynihan acuity. What is Brian Moynihan's most important focus in this earnings report?
It's funny because, to your point, the charts are better, but I want that net interest income guidance. I want to know what they're making for the year. I think that there's kind of no other story in town when we were talking about the numbers that we were talking about earlier here. Can they meet the pace of JP Morgan's net interest income growth? It is very, very significant there when you look at that 25% increase in the first 6 months of the year. Can Bank of America keep up?
Is this telling that we're seeing Bank of America beat expectations, report very robust net interest income, basically loans in line with expectations, at the same time that PNC, the king of the regionals, reports the exact opposite? Is there a divergence that's really important to draw here between these two releases?
It certainly is. I mean, remember, this is the story of the season. To what extent is money moving away from the mid-size into the bigger ones? And even among the bigger ones, what kind of business are they taking on? We are still very much sitting in a story where JP Morgan, Morgan Stanley, Bank of America, Citigroup, not only big lending businesses, but massive wealth and investment management businesses. That means Silicon Valley Bank clients. That means First Republic clients. It is a war for those clients. And remember, JP Morgan just bought First Republic. They just hired a bunch of Silicon Valley bankers. So is Bank of America then still catching that share that's falling out of the market?
Let's plan out the rest of this morning. You need some more time to go through this release and we'll give it to you. But let's get to Morgan Stanley just briefly in the next hour. Then a conversation with James Gorman later. What's the focus for you, Shonali, this morning?
I think, unfortunately, for Morgan Stanley, yes, it's about the numbers, but more it's about the succession plan. Remember, he said just a couple of months ago that he would be stepping down as CEO next year, but they don't have a new CEO yet named. So what is going to be the future of Morgan Stanley? By the way, we were talking about those Basel III requirements. They go right after Morgan Stanley, those fee-based businesses as well as the trading businesses that have had the benefit of lighter regulation for the last 10 years.
James Gorman, Morgan Stanley, in conversation with Shonali Basso, 1:30 Eastern Time. Don't miss that. In the next hour, earnings from Morgan Stanley just around the corner. B of A just moments ago. The CEO of that shop, Brian Moynihan of Bank of America, saying this just moments ago in the release. A healthy US economy growing at a slower pace. We've heard a lot of that in the last week from the banks on Wall Street. The US has a resilient job market. This from the CFO, Tom. The US consumer health has remained strong. Heard that from James Fraser as well, TK, over at Citi.
Really can't say enough about the layout of the PowerPoint of Bank of America. It is a template for big and small banks out there across America. Christopher Marinac knows this. He's Director of Research at Janney Montgomery Scott. And the big advantage of talking to Mr. Marinac is he looks at the big, the little, and the medium banks as well. Christopher, I just want to sit on the big banks right now. I noticed the fancy deposit charts, and they don't run into log where I can look at the slope and all that. But as a generalization, looking back at Friday and looking now at Bank of America, are the big banks winning because they're simply siphoning money from the smaller banks?
Well, Tom, I think the banks are paying up everywhere for deposits, so they are winning, and we've seen a stability in deposits system-wide. So it is true that it's happening at Bank of America and the other large banks, including PNC this morning, too. I think everyone is paying much more. There's a catch-up effect where we are retracing back to the Fed funds rate, but there still is a big advantage for banks. I mean, there's a huge difference between where banks are paying for deposits and borrowings and what the Fed funds rate is and where it's going. So that advantage is still intact. You're just giving some of it back because every bank has to pay up for funds. That was the lesson learned from the March chaos.
Just to build on what Tom was saying, are we basically seeing that the big banks win is the smaller banks' loss? Are we seeing that consistently as these earnings grind out?
I don't think so. I actually think the small banks had better loan growth, Lisa, and second quarter data from the Fed. You know, if you look at through the end of June, the small banks actually grew faster and the banks were flat on the large side. Deposits, I think, are about the same. We really haven't seen a big dichotomy between large and small. I think every institution across all asset sizes are paying up for funds. And so that is being translated into much more stable deposits.
We just are hearing from CEO Brian Moynihan that we delivered one of the strongest quarters in first half net income periods in the company's history, similar to what we saw with record net interest from some of the other biggest banks, including JP Morgan. Do you expect this to continue? Is this something that can be persistent, or is it a legacy of them not increasing the interest rates as quickly on deposits as they have reaped the benefits from certain loans they've underwritten?
I think it has a lot to do with credit quality still being very good. Banks are not writing a whole lot off. They are building reserves in general. You're seeing reserve building in today's releases as well. I think in general, these companies are healthy and resilient. And while you're correct that the banks had lagged on paying deposits, that's no longer the case. That is very much changing this quarter, and I think will change again in Q3. The lack of credit problems is the signature notice for the investors looking at the bank sector, in my opinion.
As you know, folks, I talk about how the big banks are hiding their success. John Ferro, and I give Moynihan and his team massive credit for the clarity here. Page 13 and 14 of this PowerPoint is a deposit clinic. I'm going to have to take the rest of the morning, avoid the surveillance nap to read every word of it. John, consumer deposits from before the pandemic are up 40%. These banks are struggling. It's a chore.
Is it difficult this morning, Tom?
It's difficult. Up 40% in what, 3 years, 1 quarter, 2.5 years? Who's keeping
Usually gets harder the closer you get to annual compensation, TK. When you've got to pay out bonuses, things get really hard.
Major credit for Bank of America for at least stating it in King's English.
True.
King, it's a British phrase.
Okay, thank you for that, Tom. Used to be Queen's, didn't it?
Yes.
Then it changed in the last year. Do you want to tell us why?
No,
okay.
Too much on it. I'm reading
Chris,
about deposits.
I want to get to a basic question, and Lisa alluded to it. Higher rates have helped these banks. Are higher rates starting to hurt some of them in any way, shape, or form?
I think you're going to see net interest margins compress, John, for the rest of the month. There clearly is a pain from margins compressing. There is also a catch-up going on in loan yields. I think loan yields are going to continue to trace higher. Credit is scarce around the country, and so as credit is scarce, banks can charge more for new loans. And I think you're going to see that a lot in the second half of this year. That actually bodes well for margins stabilizing by year end. But in the meantime, because banks have to pay more for deposits to have those deposits be stable and grow, there is some compression there. But there's an offset on the credit piece, as I mentioned, and I think expenses are behaving pretty well also.
Chris, can we build on just consumer credit? We hear from every single CEO on Wall Street and beyond that this consumer is strong, that growth is okay, but it's slowing. And then we had this Fed survey come out in the last day or so, published every 4 months, and they showed the rejection rate for loan applicants has jumped to 21.8% in the 12 months through June. They indicated that was the highest level in 5 years. They also added this one. The overall credit applications declined to the lowest level since October 2020. Chris, I wasn't sure how to read that. I'm just wondering how someone like you might read into that, given your coverage of these banks.
Well, I think that we have a society and a country that has a lot of haves and a lot of have-nots, and I think there are absolutely cohorts of households that are struggling, and I think we can't ignore that. I think that while credit is scarce, it is available in certain areas, but in others it's not, and I think that's part of what the Fed is trying to do to try to expand that. But it's a real task. It's a grind, and I think you can see in the applications and in this Fed survey that it is not where we need to be at this point. So no, I think you should take it seriously. I know I do, and it's something we have to continue to work on. And I think there's pressure for these biggest companies, particularly like a Bank of America reporting today, to do more in the consumer field.
Just to sort of bring it back to the overarching theme, if there is a constrained volume of loans, then are there some banks that are winning at the behest of others? In other words, are we seeing the gains at Bank of America, JP Morgan, even Citigroup at the behest of European banks, as well as regionals, perhaps in the margins, perhaps it's overstated?
Well, I think if you think about it as a foreign versus domestic, I think there absolutely is winning on the U.S. turf. That we're doing better there. I'm not sure it's as much a size difference between large and small as it is domestic versus international. I think that's a great point to make, Lisa. I think that there has been a bigger retrenchment outside of the United States. And so I think that is partly reflected in today's earnings and what we will continue to see the rest of this week.
Hey, Chris, wonderful to get your input. Just phenomenal, not just today, but over the last several months, particularly on the regionals as we worked through that mess a couple of months ago. Chris Marinac there of Jenny Montgomery Scott, back with us at 7:30 Eastern Time for the Morgan Stanley results in about 35 minutes' time. Back with us too, Sonali Basak right now. Sonali, we've given you an extra 5 minutes, so tell us, what have you learned in this release?
Well, a few things. To the point that we're making about the institutional businesses, Bank of America is firing on all cylinders. They're having the best kind of half year that they've had in trading in a decade or so. And if you take a look at it, what's fascinating also is that they're also currently, if you look at the mergers and acquisitions league tables on the Bloomberg league table data, Bank of America is number 3. usually that spot is reserved for Morgan Stanley. So you are seeing them actually finding the investment in talent paying off. Why is that important? Because this expense number is higher than expected. And when you take a look at why, it's compensation and benefits being a part of that number. So then you have to wonder, is activity still robust enough to keep all those people on board, to the point Tom has been making? Bank of America has been doing drips of job cuts. They haven't made that surgical large cut we've seen at Goldman Sachs. But if you're making money, it pays to keep some of these people on board.
You think that's where the questions will be on the call in the next hour? The media call, the analyst call?
I think for every bank, the expense question is a big deal. The other interesting comparative figure here is they only really brought in $2 billion more of net interest income than you saw a year ago. That comparable number at JP Morgan over that same period is $6 billion. So, we're, a billion here, a billion there. But still, it's a big deal when you're talking about where activity's going.
Shanali, stay close. Morgan Stanley still to come, 7:30 Eastern Time, so 34 minutes from now. Then we'll catch up with James Gorman, the CEO, the chairman of Morgan Stanley, in conversation with Shanali Basak at about 1:30 Eastern Time. Don't miss that. And tomorrow, we wrap it all up tomorrow with Goldman Sachs. On the market, Amy Wu-Silverman of RBC Capital Markets joining us in just a couple of minutes' time, with your equity market down by 0.06% on the S&P 500 and yields heading south. We're down another 4 basis points. Your 10-year, 3.76.
In the eyes of investors, you have a lot of confidence that we've slayed the inflation boogeyman.
I think people have been too negative all year about U.S. economic growth.
The retail trade is still on in full force.
The Fed is going to be able to pause, and it's going to be a function of this inflation data coming down.
What markets are looking to now is what's going to happen in 2024. And it's not going to be 2023 where we see revenue growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market just negative on the S&P 500. Earnings season in full swing. In the last hour, numbers from Bank of America. In the next hour, we'll hear from Morgan Stanley and push through to tomorrow as we wrap up earnings on Wall Street with Goldman Sachs. TK BofA just 10 minutes ago. Expenses for Shanali Basak and the team. Very much a focus this morning.
Yeah, the expenses are going to be there on the right sizing forward based on the view from 60,000 feet. I'm going to look from the view from Moynihan, which is, he's sitting at Fenway Park looking out at the team come back out of last place. I might point out the Yankees in last place.
Had to squeeze that in.
Yeah,
right?
to get that in there. Thank you. But Bank of America, buried in the PowerPoint, John, is the minutia that Moynihan lives on. Equity business, the doom and the gloom. Oh, specs are over. Things are terrible. We're not going to be able to buy the third home in the Hamptons. You know what? It was down 2%. Teensweets pullback there, and a VAR that was unimaginably small based on my amateur take. And the bottom line here is this is why scale matters. This is why big, what I talked about, the great hijacking that McDonald was talking about 30 days ago. Bank of America is part of that great hijacking. This looks to me like a really big, well-tuned machine, given all the challenges.
Lisa, Bank of America in the pre-market right now positive by a little less than 1%.
That's after delivering a 19% gain in revenue versus the year earlier. Just to put this into perspective, it is a game about net interest income. And you asked a great question in the last hour, John, which is, when does that end? Do we see a sort of end of the tunnel for this incredible boon that we've seen at JP Morgan and now Bank of America, as they haven't had to pass along some of that interest to depositors as much as they've been able to reap it from consumer loans that keep performing? A lot of questions with consumer lending very much in focus.
A beat on trading revenue as well. Shanali Basak's going to be back with us in the next 20 minutes or so. We're going to break down the Bank of America numbers for you and get our teeth into Morgan Stanley when those numbers drop. The equity market this morning shaping up as follows on the S&P 500. Equity futures are just slightly negative. We're down by 0.03%. There's a bid into the bond market. Yields are lower by 4 basis points at 3.76. We won't spend a lot of time on this, but the ECB, one hawkish official, so-called hawk anyway, just being very non-committal around what they should do after July. So is it a July one and done from the ECB like it may well be for the Federal Reserve? I know a lot of you have got that call in mind. So the bond market is bid, treasuries are rallying, but still the euro is stronger I've said that, Lisa, for 9 consecutive days. 112.55 on a euro.
Which is kind of amazing if people justified the euro strength with a much more hawkish ECB. At this point, is everyone betting on a soft landing? Today, we do get more bank earnings. Morgan Stanley, as we've been saying, at 7:30 a.m. This follows what we got from Bank of America, which was a beat. We are seeing the shares pair some of the gains they initially saw, up 0.7%. Morgan Stanley shares up about 1% before that earnings. We're also going to be getting Western Alliance after the bell, after we did get PNC. The regional banks very much in focus to see if this dichotomy widens between the big and the small. Today, G20 finance ministers and central bank governors are continuing their talks in India. Curious to see whether other central bankers make similar types of noise, is what we heard earlier today from the ECB. Everyone is seeing a soft landing, it seems. And at 8:30 a.m., the latest read on the consumer at a time when we have had more stability in gasoline prices. You could strip out some of the volatility there and get a sense of whether people are spending less on discretionary items. This is one of the key questions, John, underpinning retail sales at a time when every single executive says that the consumers are still spending, albeit maybe at a slower pace.
So far, it's just the recession that never was. Citi and Andrew Hollenhorst publishing just moments ago. It was great to catch up with Veronica Clark in the last hour. A recession in theory, Tom, not in practice.
I really take issue with this after seeing J.P. Morgan. I'm fascinated to see what Fortress Gorman does. We're going to have a national slowdown of some form of sort of recession, actual NBER, whatever the jargon, the words you want to do. These banks are prospering off a financially successful America. I get the political thing. I get that half the America's flat on their back. I've never seen those numbers, and to be fair, they go back and do a pre-pandemic analysis. They're booming, period.
Morgan Stanley, 25 minutes away. Joining us now, Amy Wu-Silverman, the head of derivative strategy over at RBC Capital Markets. Amy, wonderful to have you with us on the programme. We've had the bank earnings over the last week. The banks have lagged what's happened with tech. Pretty much everything has. Tech has absolutely dominated year to date. Amy, I'm sure you feel the same question that we ask repeatedly over the last several months. Can this rally broaden out? Do you think it can?
I do, John. I actually think you are seeing that already in the options market. You know, we kind of take that metric of call exuberance. You know, where are folks buying single stock call options? And of course, that was in your NVIDIAs and your Apples and your Googles, not too surprisingly, a couple of weeks ago. But we've really seen that expanded not only to S&P, but also to IWM names and also to smaller and mid-cap names. And that's kind of happening on a much broader basis than it was before.
Amy, let's cut to the wheelhouse. It's what everybody on Global Wall Street wants to know from Amy Wu-Silverman. What are the cross moments saying right now, the four dynamics of the option space? And critically, to get a little bit jargony here, what does skew do right now?
You know, Tom, it's doing a whole lot of nothing. And I always say memory is really short in the options market, and it's gotten even shorter. So the folks who have had on, you know, long put trades, hedging trades, they've been burned. The best strategy year to date, when you backtest every option strategy, has been to be long the S&P 500. So no option strategy year to date has actually just beaten being long the S&P. And, you know, you've seen that kind of taken to heart in the VIX levels and the volatility suppression that we've seen.
Right now, you said that you do expect the rally to broaden out. What are you looking at specifically for the areas to benefit the most in this broadening at a time when some people still are expecting consumers to stop spending as much?
Yeah, interesting question, Lisa. And I think, you know, it goes back to all these rotation trades that I think investors had wanted to put on even, you know, 6 months ago, even after the October bottom, which is value versus growth, or, you know, finally small mid cap versus large cap cyclicals, those type of areas. You know, one thing I will say as a caveat is I've asked investors why it couldn't be the case that we could just simply have a parallel rally. You know, so mega cap tech doesn't necessarily get hurt, but we just simply broaden the rally because one is sort of a secular drive of AI and the other is more of an economic recovery story. And to be clear to my earlier point, you know, we're not seeing less bullish positioning in tech. It's simply that bullish positioning has widened out a bit.
This is the reason why some people are saying, okay, let's just hold on a second before everyone gets over their skis in the soft landing type of narrative. Because if you look at the data, more people are invested than have been in equities going back for quite a while. We see a much more overweight suddenly in market technicals. At what point does that become a concerning sign to you?
Yep, I watched this too, because I do think, part of the story from the beginning of the year, Lisa, was that there had to be this catch-up trade, right? Well, one of the reasons I think we thought that positioning would get even broader was there are just folks who at the index level had to catch up to the momentum you were seeing from 7 names contributing so much to return. Now, from a positioning perspective, we are in a much better shape. But the question is there even more to go? I think there is if the rally becomes broader. And the second thing is, you get these kind of technical rebalances, the technical rebalance for the NASDAQ, for instance, which will give folks who really couldn't participate in that narrow breadth to have some excuse to continue to do that widening breadth.
Does diversification pay here, Amy, or is it better to place larger focused bets?
So, Tom, it's interesting because we always think about that from a correlation perspective, and correlation has been really, really low on a realized level and an implied level because it's been, tech going this way and then everything else going the other way. The one thing I point to folks is, look, if we get more things widening out and that breadth going, even larger, then maybe that picks up the correlation component of index volatility. So to your question, maybe the reason volatility goes up and we see a few points tick higher is actually because of that widening of breadth, which actually makes your correlation component what kicks the vol into higher gear.
Interesting. Amy, thank you. Amy Wu Silverman there of RBC Capital Markets on the potential for this market rally to broaden out and the potential for this so-called soft landing to materialise. We've had so much commentary in the last day on all of this. We mentioned Jan Hatzius and Goldman Sachs saying the recession odds have been cut over at Goldman from 25 to 20. There was just this idea from the likes of Goldman, from Morgan Stanley and Seth Carpenter, that maybe you don't need that recession to get inflation back down to some kind of acceptable level. And even to hear an equity market bear like Marko Kolanovic of JP Morgan in the investment bank say that downside surprise on CPI means a narrow path to a soft landing is now modestly wider. I think that's the closest, Bramo, we've come to any form of capitulation from the team over there.
Yes.
That's it. That's all you're going to get, but it's something, Lisa.
And we're going to cling on to that because as far as we're concerned, it's actually a pretty big capitulation. At this point, though, here's my fundamental question. If we are seeing disinflation, but people truly believe that the lag effects have not fully been felt yet from the higher rates that the Fed has put on, then does that mean that there will have to be softness that people aren't anticipating later on, especially based on people not looking for loans as much and getting rejected, as you pointed out, when they do?
Yeah, I know where the soft landing consensus hopes and dreams are right now, but if you go beyond that, the division around this story is pretty remarkable. Veronica Clark was on this programme from Citi in the last hour talking up the potential for re-acceleration in inflation in early 24. Torsten Slock of Apollo was on this programme in the last week talking up the lagged effects of tighter monetary policy that's going to bite in the next 12 months. Now, TK, that's a big range of views out there. I'll touch base with Jim Bianco of Bianco Research in several hours a little bit later this morning. And this is your phrasing. He thinks the disinflation is transitory. Never mind the inflation.
But do the companies like Bank of America or, frankly, Western Alliance at 4 p.m. this afternoon see Romain Bostic for that? John, let me cut to the chase. Do they do any poorer with that inflation outcome? I'm not sure. I mean, they're adapting and adjusting, and they're minting money.
That's what companies do, Tom.
That's what
they adapt and, what was it? They adjust.
They adjust.
That's right. That's right.
Can we adapt right now?
I think that you did that good.
Joel Levington is the smartest guy in the block. I mean,
that's true.
He's a Bloomberg Intelligence, and he does credit. He has just published, John, that 296 GTB Ferrari you want.
Yes.
Go down Madison Avenue looking, for what you can. I mean, it's popping in. The EBITDA on that Ferrari is $175,000 profit. That's what Ford pickup trucks having trouble with. The margin on it is $175,000.
That's called a luxury margin.
That's a luxury margin. Joel Levington to the rescue today.
Have you been past the showroom on Park Avenue?
I have. I've never been in. I know you've been in.
I haven't been in. I'd just like to have a look.
I agree totally.
I just love telling.
Why don't the others more do it? That's what I don't understand.
I don't know. It's just so beautiful. Is there anything more aspirational than that? It's just,
I think the green team. The green team
beautiful.
is trying.
Oh, no.
They're trying. Aston Martin. They're doing the same thing.
Yeah, I noticed.
They're
I noticed
showrooming.
that too. Okay, from New York, welcome to the programme. If you're just tuning in, equity futures right now on the S&P negative by 0.05%. Coming up a little bit later this morning, in about 17 minutes' time, we'll pick up the coverage around the bank earnings again. Morgan Stanley results just around the corner. Tom, and then it's on to James Gorman, a man we all respect, hold in high regard.
Looking at Wealth Management, Bank of America, the stunning and Republican-influenced J.P. Morgan Wealth Management. First thing I'm going to turn to with James Gorman is what he built doing, and that is with E-Trade, Eaton Vance, and the rest of it coming in, what is Morgan Stanley Wealth Management doing?
Who comes next? Got to work that out with Sonali Basak too. As James Gorman
small
heads to the
matter.
exit.
You think bombshell announcement today? I don't know.
I don't think so.
Lisa
what would I know?
Shallot?
Bramo's got the
Lisa
inside.
Shallot would run it with an iron
Is
fist.
he going to do the Bob Iger? Found a successor.
It's me.
He's got two thumbs and is right here.
It's me. It's going to take a little bit longer to find one, like another 2 years. I mean, come on.
Yeah.
From New York, this is Bloomberg.
We are looking carefully at outbound investment controls to make sure that we've covered all the channels by which technologies can be transferred to China that we think pose national security concerns. If we go forward with these, they would indeed be narrowly targeted.
This is a really important conversation. The US Treasury Secretary Janet Yellen with Bloomberg's Anne-Marie Jourdain. The two words that matter there, narrow and targeted. The team here at Bloomberg learning this morning that the US is planning a narrow limit on China investment, outbound restrictions. The story reads as follows. I'll share the lead paragraph with you. The Biden administration plans to restrict investments in China, and they will be narrowly focused on cutting-edge technology. Only new investments, TK, and they won't bite until 2024. So for the hawks down in DC, this is important. It's going to be narrower, potentially, than anticipated, and it's not going to come quickly enough for a lot of people either.
You know, it's gallium and germanium, and we make fun about it, and we all flunked this in chemistry class. Anne-Marie Jourdain killed this in chemistry, by the way. But the answer is we make jokes about it, but it's really, really serious. And they're looking at a bipartisan focus on batteries. And there was a chart in The Economist this weekend that showed the climate change differential and the build out necessary for batteries to make all this EV stuff go is ginormous is the only mathematical word I can come up with. It's huge, and that's what they're focused on.
And is it achievable not working together? Can you hit some of those targets?
I don't know, but
there's some common ground between these countries, Tom.
There's common ground there about the technology to come, but the debate to me is a political debate. Anne-Marie Jourdain, off of her Yellen interview yesterday, can assess the politics here in Washington. Anne-Marie Jourdain simply, can everybody get behind what the Secretary of Treasury is proposing, which is a narrow China proposal?
Well, it's an interesting line for the administration to walk because this will anger some of the hawks in Washington, D.C., which wants to see a more broad outbound investment executive order. They want to see a larger scope and size, not something so narrow, not something so direct when it comes to the outbound investment. Basically, it's going to be reverse of CFIUS that will track this going over to Beijing. At the same time, it comes to the administration is trying to put a floor on relationships. Right. And that is why in the Treasury Secretary's most recent visit, her visit to Beijing, she outlined what this outbound investment would be, because we already know that this has angered Chinese authorities. They say this is the U.S. trying to isolate their economy and go after their economic development. And that is part of the reason why she also went. So they are trying to make sure they can keep relations stable, but at the same time ramp up some of their concerns when it comes to national security.
Anne-Marie, cut to the chase. How will China retaliate if we go after, say, rare mineral battery technology?
Well, I think we need to see what ends up coming out in the executive order. It keeps slipping. Jake Sullivan called for this more than 2 years ago. My reporting more recently was that it's supposed to be done by the end of July. Our colleagues are reporting now, end of August, and then it goes into a hearing review with the public. So we're not going to actually see it take effect until next year. And then that would likely be the time we would see a response from Beijing. But if it's very narrow in scope, potentially there isn't a response.
How does the China discussion play into 2024, which may be when these sanctions take effect? But it also is the election, and it becomes a very political moment where Biden is looking to really hold on to his seat with pretty razor-thin margins.
Well, the rhetoric is just going to get hotter and hotter every single day when it comes to Beijing. Every candidate is going to be asked how they feel about relationship with China, what they would do in terms of whether it's Taiwan, whether or not it's human rights concerns coming out of Beijing, whether or not it's Xi Jinping still backing President Putin, not condemning the war in Ukraine. Every candidate is going to be asked about this, and the rhetoric will be obviously very hot. It is advantageous to run a political campaign to say you are a China hawk. That polls very well. So that is what is going to happen as we go into 2024. So for this administration that wants to make sure they also have a dialogue with China, it's going to be a hard needle to thread.
Talking about the election, the former President Trump ostensibly is putting together a plan to overhaul the executive branch, this according to the New York Times. Our current executive branch, this according to the architect of this new plan, was conceived of by liberals for the purposes of promulgating liberal policies. There is no way to make the existing structure function in a conservative manner, talking about eliminating the deep state. Does this fly? Is this a popular approach with others in the Republican Party?
This sounds like this is a very Trump populist approach for him and his base, the 30% stronghold that he has. The issues that the others in the party face is that they are trying to not just knock away some of that 30% hold he has, but also gain a larger majority than him. And what many are concerned about in the Republican Party that do not want to see a Trump 2024 nominee is the fact that we could see what we had in 2016, which just comes down to a plurality. No one gets the major popularity, but he will still maintain that 30%. Everyone else just divides it. But this sounds like something that is very Trumpian, less so what we'd see potentially from other candidates.
I look, Anne-Marie Horton, at the calendar for July, and we're sort of into the summer doldrums right now, and it just gets completely upset by Republican politics, as Lisa mentions as well. I am thunderstruck over the raising of money. I know you're really ready on this. Give us your treatment across, 18 candidates? What's the biggest surprise for you in the inability or ability to raise money for the GOP?
I think the biggest shock had to be the money that Mike Pence brought in the second quarter, $1.2 million. We're seeing members of Congress bring in more money than him. This is a former vice president, that makes questions on whether or not he even meets the threshold to go on the debate in Milwaukee at the end of August. But that, for me, was very shocking that this is a former vice president and the money he brought in was so low. I think another big shocker on the other side of the aisle is, of course, Biden brought in $72 million in the second quarter. The campaign says they have $77 million cash on hand. So that speaks a lot of optimism from his backers about the former president, the current president, even though poll after poll continues to show that many in the electorate are concerned about Biden's age.
First debate, a month away for the Republicans. It's amazing. It's just around the corner.
Yeah.
Anne-Marie, we've had a conversation about whether or not the former president would show up to that first debate. Any read on that right now?
Not at the moment. I think he says he's not sure yet, or he says he won't. I think for Trump, he just views it as almost pointless. He has the 30% hold he needs. Why would he show up when he's probably going to be attacked by everyone? But at the same time, others say he loves his show. So if he's not part of it, that potentially won't bode well for him. Maybe he does counter programming. Remains to be seen, but a lot of individuals like Chris Christie are really trying to troll him to show up on that debate stage.
Oh,
but
big time.
TBD.
Christie's out for him in a big way. Anne-Marie, thank you. AMH down in Washington, D.C. Put that one on the calendar. August 23rd in Milwaukee, the first GOP primary debate hosted by Fox News. TK, that's one to watch. That's a big field that needs to narrow down fast.
Early and often, I think that's a key word, is you got to narrow it down. And what's interesting to me is the little micro battles I see. I've been focusing on Iowa, but, to be direct about it, the conservative and evangelical heart of Donald Trump's GOP party has a voice, and they're letting it be heard on the road to August.
Coming up shortly, we're going to change focus away from politics and get back to the banks. Bank of America reporting a little bit earlier this morning. Morgan Stanley coming up very shortly. Those numbers should drop in around about 5 minutes' time. Chris Marinac of Janney Montgomery Scott reacting to those numbers in just a moment. And Bloomberg Sonali Basak back with us in the studio to break down the results from James Gorman's team and look ahead to a conversation with the CEO and chairman of Morgan Stanley, James Gorman, and Sonali Basak, 1:30 Eastern Time from New York. This is Bloomberg. Earnings from Morgan Stanley are seconds away. Going into it, equity futures on the S&P 500 negative by 0.04%. On the S&P 500. On the Nasdaq, we are down by 0.12%. Just a little softer, but absolutely no drama whatsoever in the equity market this morning. In the bond market, there is a rally. It resumes. Treasuries firmer, yields lower by 4 or 5 basis points on a 10-year, 375.79. Looking at a 2-year right now, down about 4 basis points on a 2-year. Just a little north of 469 on a 2-year, down 4 basis points. Numbers from Morgan Stanley. Just dropping. I'll allow Sonali to get through that and just finish up with the euro just quickly. The euro advancing for a 9th consecutive session. We are stronger on the euro against the US dollar for the longest streak going back to 2004. Here are some numbers for you from Morgan Stanley. Second quarter wealth management net revenue, $6.66 billion. The estimate, $6.5 billion US dollars. There's a lot in here. Sonali's had a couple of seconds to break it down. Sonali, just give me your first look, and then we'll give you some more time to get through it.
Morgan Stanley back on top, beating on equity, sales, and trading revenue. We know Morgan Stanley is the kingmaker in that room. Fixed income sales and trading, however, slightly shy of expectation. That's a bit of a business that they're trying to grow and compete on at a greater scale. They're kind of the baby of the group there when you compare them to JP Morgan and Goldman Sachs. Now, wealth management revenue coming in above expectations, and James Gorman in his statement really highlighting here that $100 billion in wealth and investment management net new assets, bringing in over $200 billion year to date. That is a number that he wants to bring in more than $1 trillion every 3 years, and so he is showing you that they are well on track. And also the story we've been talking about all morning here is how much more business can they squeeze out as some of these other banks have shed the market.
I want to go to more on comparing. We're not comparing Morgan Stanley to JP Morgan, right? We're comparing them to Goldman Sachs.
I think they deserve the JP Morgan comparison when they're both trading at almost 1.6 times book value.
Fair.
So you're getting Morgan Stanley here with a lower ROE for the quarter, but the similar
I
book
get that,
value.
but I'm
trading.
looking at a pre-tax margin on what matters, wealth management for Morgan Stanley rather. They're going to go to the decimal point here. 25.2 is different than 25%.
But 25.2 is actually less than expected. And so, at the same time, they have cost to contend with just like anybody else.
How did she pull an all-nighter before this?
Quick question, Sonali. I'm looking right now at net interest income, which actually came in below expectations, coming in at around $2 billion versus the estimate of $2.3 billion. How concerning is that at a time when the likes of JP Morgan and Bank of America meaningfully beat?
Yeah, and I think that is very important. It's to the point we're all talking about here. When we look at the numbers, we know that the market is quite soft across the board. And to Brian Moynihan's point, slowing. And so the competitive pressures here are stark. And these businesses are being competitive on every business line, including the bottom line, including costs. And so one thing that's interesting here is you have Morgan Stanley already highlighting, for example, severance costs. And that is a spare cost that everyone has to contend with in terms of compensation costs. The unfortunate thing about severance costs is that these are not costs that are necessarily adding to that top line for that competitive pressure we've been talking about.
Stock is up this morning in the pre-market. You mentioned Brian Moynihan. Let's talk about the arc of the quarter, according to James Gorman of Morgan Stanley. The quarter started with uncertainties and subdued client activity. The quarter ended with a more constructive tone. What do you make of that?
You know, we've been talking about this, the disparity between the types of clients you have. For Morgan Stanley, you are banking the creme de la creme, and it is across America, which is kind of a less choppy market than you see in a lot of parts of the globe. That wealth management pre-tax margin, the reason that they missed is because of those expenses we're talking about. Now, they do have record net revenues in that business, and so the multiple you're getting at Morgan Stanley is really driven by that booming wealth business that is just raking in money.
I mean, I want to go to Goldman Sachs tomorrow as well. To be clear here, particularly for those that are not sophisticates like this on you, they don't have a Marcus, do they? I mean, they don't have a distraction.
They don't have a consumer business with such ugliness in it. They don't have such risky clients in that consumer business. As we've been saying, they bank the wealthier, and they do drive net interest income that way. Now, there's another thing Goldman Sachs has that Morgan Stanley doesn't have, and that is potentially $2 billion worth of write-downs tied to that consumer business, the Green Sky consumer lending business, and importantly, a commercial real estate portfolio that is baked into their asset and wealth manager here that they are trying to compete with Morgan Stanley on at scale.
Just quickly, early question for the man himself.
Succession. There's no other story for Morgan Stanley.
Even after that.
With these wealth management numbers, you have to ask, what does the board want of a new candidate here? Do they want an asset and wealth management head? It's the same reason Dan Simkowitz, Andy Saperstein are competing so heavily with Ted Pick, the institutional guy, you know, a year ago you would have said he had a shoe in, and it was his to lose.
This is very funny. I would suggest that perhaps the board of Morgan Stanley, and I got a friend, Mike, that's, I think, pretty good about this. Probably what the board is going to say, can you find someone that won't screw it up?
Yes, given the trajectory they've been on
I'm just
under
borrowing
Gorman.
That from a guy, Mike, who
There are
happens to watch
headwinds
the
that
show
they
once in a
have
while.
that James Gorman won't have. They have more regulation in the businesses that made James Gorman a lot of money in the last 10 years. And so that means pressure on ROE no matter what.
Shanali, thank you. 1:30, don't miss it.
Fascinating.
Coming up a little bit later this afternoon, 1:30 Eastern Time. James Gorman, the Morgan Stanley Chairman, CEO, in conversation, Tom, with Shanali Basak.
To provide context, Christopher Marinac, Jenny Montgomery Scott. Thank you, Christopher, taking time out from your clients this morning. Is Morgan Stanley a bank?
Absolutely, sure. They make loans and take deposits. Their deposit costs rose a lot in this quarter, Tom. I mean, they had 100% beta if you look at the change in average deposit costs from first quarter to second quarter. So that's 47 basis points, which is exactly what the average change in the Fed funds rate was for the quarter.
I am fascinated by the compare and contrast with the mystery of what we'll see tomorrow with Goldman Sachs. To begin that study, what's the key distinction here of a Marcus-like free Morgan Stanley?
Well, I think Morgan Stanley can get access to funds cheaper than what Marcus is paying. Marcus is the rate leader in the marketplace, and so that has a different spread component at the bank level, and I think that's awfully important. I think there's less of an advantage at Goldman on the cost of funds, and so that's one thing that most banks have, and certainly Morgan Stanley does have an advantage in terms of borrowing and raising money cheaper than the cost of Fed funds.
As we parse through the results, and Shanali was great about pointing this out, at Bank of America, the average FICO score was 767, an incredibly high, very well-off kind of customer base. We're seeing a similar type of suggestion in the numbers of Morgan Stanley. What does this mean for those who are not in the echelons of the upper tiers of income earners? Does this mean that they are not getting credit, or does that mean that they're going to the PNCs of the world, maybe the Western alliances?
I think all those banks tend to have a higher FICO score in general. So I think, unfortunately, they're probably looking outside of the banking industry and other sources, which really means that it's more expensive. I think that's the hard part. The banks are bragging about having high FICO scores, and that kind of cuts both ways. It's good from a credit quality perspective, but it does make it difficult for certain borrowers to access funds from a consumer standpoint.
Right now, as you take a look at Morgan Stanley, Bank of America, JP Morgan, Citigroup, Wells Fargo, who looks the best to you in navigating a pretty uncertain time?
Well, Bank of America has the best deposit base in the country, and so that gives them a leg up. I mean, they have access to consumer funds that are cheap, and they have a big advantage over Fed funds, as I mentioned earlier. I feel that they've got a lot going for them. They also have been a leader on the digital build-out. JP Morgan has too. And, those are two big engines in the whole transformation of the industry towards digital. That's going to continue to, create a wider gulf between other banks in the quarters ahead.
Hey, Chris, in the zeitgeist of this July is a massive roll-up worldwide in asset management. Clearly active management, but dare I say also index passive management as well. Is Morgan Stanley one of the giant players that can take advantage of that roll-up, or do they have to grow and defend against the roll-up?
Oh, I think they're in growth mode. I think if you go back to March and April when we had the explosion of First Republic, they received several clients and teams of people. And I think that's going to bode them well. Even though they did not bid on the bank, they still had a lot of transactions and new customers that have come in. And I think that's going to become more apparent on the asset side in the months ahead.
Sonali Basak is studying the succession plans as well. You're a student of it. What kind of person should be taking over? A wealth manager, a banker, somebody from outside?
I think you need one who can be a leader. At the end of the day, you need a person where he or she can really focus on how to lead an organization, bring in new clients, being able to be flexible when you have market volatility like we've already seen this year. That's really is what it's about. I would be less about labels about whether they came from the investment side or the bank side. I think being able to lead a team of folks and grow the business in the next decade is what I think is most important.
Hey, Chris, appreciate you being with us this morning. Chris Marinac there of Jenny Montgomery Scott of Bank of America in the last hour and Morgan Stanley numbers as well. Goldman, the last big one still to come. They report tomorrow morning. TK, Goldman, the last big one, and the bar's set pretty low. Let's put it that way, given some of the communication we've had.
Well, the communication, I've never seen the mystery in the press different. It's not just Bloomberg, it's others as well, just saying, okay, what are we going to see here? And the massaging, I should say, not managing, the massaging of the message is going to be fascinating tomorrow.
I'm also curious, before tomorrow, just some of the earnings calls that parse through some of the data that we got from Bank of America and Morgan Stanley. Just looking through the numbers, Morgan Stanley's second quarter compensation expenses were $6.3 billion. The estimate was less than $6 billion. We're going to be talking about efficiencies. Where do those cuts come into play? How significantly will they be affecting some of the populations? These are some of the questions that are ongoing at a time where people really are looking for places to trim around the board.
These moves fading this morning. We're positive by 0.4% on B of A. Morgan Stanley up by 0.4%. Tom, not just about the major players, it's about the regionals as well. We've talked about this a few times. A few months ago, it was a completely different earnings season on Wall Street. Just totally different atmosphere around the financials compared to where we are now.
Yeah. And frankly, and I am as guilty of this as anyone, dare I say Western Alliance is of equal interest.
Sure.
Is Morgan Stanley this afternoon at 4 p.m. Here's the book value study. This is the acclaimed BQ screen in the terminal. It's one of the reasons people buy the terminal every day worldwide. It just gives you a snapshot of the ratios of a given company. Price to book, Morgan Stanley 1.57, Goldman Sachs 1.02. That is a wow differential.
There's a different set of pressures at the top of Goldman, would you say, Tom? Compared
massive.
to the top of Morgan Stanley, whoever takes that seat.
You know, I have to put the surveillance cork in my mouth. Basics like.
Have you ever found that cork?
Oh yeah, there's a supply down here.
Is there?
Yeah, but it never gets up to the
never
area.
Talked about it a lot. Never seen it.
Never seen it.
No,
Right.
we did. There was a sighting once. I remember that clearly. The taste.
What year was that?
Oh no, it was recently.
It was recent. Okay.
Yeah,
the 80s.
It was when. Yeah.
Just tuning in. Welcome to the program. Equity futures on the S&P, negative by 0.09%. Morgan Stanley out with results just moments ago. The stock is fading, Tom, in the pre-market. I'm looking at the pre-market right now. Morgan Stanley is positive by, let's call it 0.4. Bank of America up by 0.3. It's been a beat across the board, would you say, so far on Wall Street, TK, relative to expectations?
But there's a little bit of nuance, in the typical things that Sonali follows. I'm not a student of them, but, I'm not going to mince words, John. It's uneven, I would say. Across the different companies.
Uneven, and yet we've seen some pretty dramatic numbers, I should say, in terms of incredible revenues from net interest income that's gone up. And yet Morgan Stanley shares year to date 3.3%. JP Morgan shares today are the real outliers, up 17%. But, Bank of America shares down 9% year to date and not really climbing that much after better than expected earnings.
We'll get back to the market price action in just a moment. Greg Peters of PGIM Fixed Income will be joining us shortly in the next hour. Looking forward to catching up with Jay Bryson of Wells Fargo, Ed Morse of Citi as well. Ed's saying that the commodity bulls have got this wrong, that the crude oil bulls have got this wrong, and you should keep an eye on what's happening in China. Crude this morning, just to check out WTI and Brent on my screen at the moment. Crude south of 80 in the last 24 hours. To give you the quotes on Brent at the moment, 74.50 on WTI, on Brent 78.80. On the fixed income market, with treasuries rallying and yields lower, Greg Peters of PGIM Fixed Income coming up shortly, a week and a day away from a Federal Reserve decision and potentially another rate hike from Chairman Powell and the FOMC.
Fixed income, this is a pretty good scenario. This is nirvana for a fixed income investor, where you can get sixes without taking a lot of interest rate, credit risk, beta risk. You can build a portfolio, hold some equities for some upside, and then build a lot of income in your portfolio. It's a pretty good environment for a fixed income investor.
Rick Reeder, CIO of Global Fixed Income of BlackRock, subscribing to the idea that maybe you get that soft landing, but ultimately sees a lot to like in fixed income at the moment. He found their way at the start of the year and still feels it this time of the year, at the middle of the year, in June, July. Going deeper into July and seeing a bond market that is rallying. Yields are lower on a 10-year, on a 2-year this morning. Let's pull up the board and have a look at what's happening. On a 10-year Treasury, yields are lower by 4 basis points, 376.38. This dollar sell-off continues, but only just. The euro 112.43, Tom, this morning. Higher the session on the euro today, getting closer to 113. I can tell you your session high was 112.76. Not far off, eh? It's quite a turnaround.
It's still a resilient euro, and you see it across other things. Forgetting about the idiosyncratic Turkish lira, which is going to print a 27 here any moment. That shows the chaos out there in Turkey and Argentina. I would point out to Rick Reeder, John, and I think this is really, really important. The sum total that I look at is the Bloomberg Total Return Index, either corporate, as we discussed yesterday, or total return aggregate. And the answer is it's an in-betweeny space where price really hasn't come down, price really hasn't come up.
Have we seen the peak in yields? Maybe at the front end, given what we're hearing from central banks, not just the Fed in the last week, but also from the ECB. Those comments, Tom, haven't spent a lot of time on them, but to hear a hawk on the Governing Council say, yes, sure, July, let's go, but ultimately in August and beyond September, who knows what we do in September and beyond?
The manufacturing pulse of Germany here, we've got such an important guest now. I want to get through this quickly, but the read of the weekend was Christian Odendahl over in The Economist on the delusion of manufacturing, and that speaks right to Odendahl's Germany. I mean, it goes right to the
totally different growth profile in Germany compared to the US right now. Couldn't agree more. The China influence is huge compared to the United States.
Went back and forth with Mohammed Al-Arian on that yesterday. We'll keep that theme of manufacturing here through a hot summer. Gregory Peters is cool, calm, and collected, co-CIO at PGIM Fixed Income right now. Greg, if I define a given aggregate index as in between here, maybe on a technical basis, it's a pennant formation. Which way is price going to break? Are we going to get higher price, lower yield, or the other way around?
I think it's the other way around. If you look at what's going on in the market is very excited around policy rates peaking. But if you see what's embedded in the future price, there's talk about soft landing, inflation coming down, and then on top of it, you have pretty substantial rate cuts. So those two factors are somewhat confusing to me, right? If the economy continues to actually chug along here, we avoid a recession, I'm not necessarily sure why forward rates should be 200 basis points lower than they are today.
I look at where rates are and what is going to give way. From where you sit, how will issuance change given price down, yield up? What will be the spirit of the market?
Well, what we found over the past, couple of years is that there's not a lot of price sensitivity here. Corporates will issue when they have to. there's a constant desire to issue. So I don't really worry about that factor too much, honestly. So, to me, I think it's steady as you go. So I think it's a very good environment for fixed income, for sure. But at the same time, some of the pricing confuses me.
Okay, let's talk about that, Greg, particularly in investment grade. Why do you think that prices are just too high?
Well, it's not so much. Well, it's pricing in a soft landing, which I think should be the modal outcome. But the risks are still, pretty elevated. And so I look at, IG credit spreads, index level, just called 125 basis points. That's well below the long-term average, long-term mean. High yield is sub 400 basis points. So you're not getting paid a lot from a spread premium standpoint vis-a-vis the risk out there. But the overall yield environment is a fantastic one. And I think that will continue to drive flows into fixed income. It makes fixed income a very attractive place as we're back to the roll and carry days, which I think is the hallmark of fixed income investing.
Typically, after banks report earnings, they issue a slew of bonds. We saw Wells Fargo float an offering yesterday with an 8 handle, offering more than 8% yield. It was on a subordinate bond with equity-like features. Is this a type of asset that you want to own? Are you looking to the big banks and saying, I'm a buyer?
Yeah, so the key point there is equity-like features, right? So I've always been of the mind, we've always been of the mind that that's a poor risk. You have fixed income type of yield with, equity optionality. So the option is always against you. So never really liked that part of the market, known as the COCO part of the market. But the senior place looks very attractive to us and continues to be. So, the money center banks, as we call them, are a very attractive investments in fixed income and continue to be one of our favorite places to play in investment grade corporates.
The theme with price down, Greg Peters, is I'm going to get a coupon along the way. I get that rationalization. But as a general statement, out 1 year, or dare I say out a PGIM short term 3 years, are you going to clip a coupon or are you going to invest out 3 years for total return?
I still believe that given the shape of the curve, given the attractive nature of the front end, to me, it doesn't make a whole lot of sense to go out in duration. So I think front end carry, just call it 3 years in Tom, a very attractive place to play. So I don't really see the need to kind of reach, right? I think investors are still very much in the reach for yield environment, going back pre-pandemic. And the truth of the matter is you don't need to reach now, right? It's right in front of you. So there's no reason to take, unnecessary amount of credit risk or duration risk at this point in time.
Does this mean that you don't necessarily buy into the soft landing narrative, or just that it doesn't matter whether there's a soft landing or a hard landing, you're going for the sure thing?
Well, so I mean, you go to the soft landing narrative. So I don't understand, this is the price confusion in my mind. I don't understand, if you believe in a soft landing, why the Fed would be cutting 200 basis points at the same time over the next, year or so. So to me, that's the incongruency in the market. So if you actually do get a soft landing, right, I think front end yields will remain pretty sticky. So maybe there's a little cuts, into the market. But that should help normalize the curve, which means, the inversion starts to normalize, and that means kind of higher yields across the curve. So that's how I see it, actually.
Greg, one of the best. Always a privilege to listen to you. Greg Peters there of PGIM Fixed Income. Thank you, Greg. Mohammed Al-Arian said on Friday, this market has rallied this year on things that haven't happened, not on things that have. Just think about that, this earnings season. We came in and we were worried about things like credit quality, and there's just been nothing scary so far, Tom, in earnings season so far.
It's the ex-ante bet in an ex-post world, and particularly as for central banks, they look after the fact. And what Dr. Al-Arian is suggesting is the market's always out expecting. I like to say on the equal sign, there's expectation on both sides.
It's also the delay in some of the read-through effects of monetary policy. And I keep thinking back to that Fed survey that you mentioned, John. This little nugget, the rejection rate for auto loans exceeded the application rate. This was for the first time ever since the survey's inception in 2013. Just to give you a sense of the changing credit dynamic that's happening in real time.
It's just amazing, the pushback you're starting to see, Tom. There are people struggling. You talk about it a million times. TK, a lot of America flat on its back, struggling to obtain credit. And then we went through B of A, and the average credit score of their customers is in the high 700s. For anyone that tracks their credit score, anything north of 700 is pretty tidy. High 700s, it's pretty decent stuff, Tom. That means you've got a pretty solid consumer at your company as your customer. I'm not sure that's an accurate description of everyone in this country right now.
In the Goldman Sachs tomorrow, and frankly, all of earnings season, and I look forward to what we're going to see through technology at least. And everyone's rationalizing. As I said before, it's Rationalization Tuesday. And let's go to someone you follow more than me, John Kalanovic at J.P. Morgan, where he's talking about it's modestly wider. You know, the chances of getting to a soft landing, it's modestly wider. I think there's an adverb in there somewhere.
It's about as fast as he would go, that the path is still narrow, but it's modestly wider after the data of the last week.
The Red Sox are out of last place, so we're rationalizing.
Where are the Yankees?
The Yankees, I believe, are in the, when I filmed at Fenway, the Yankees were in last place. They've returned. They've returned.
Is that because of the release of your special coverage of
the
Red Sox?
Get a shortstop.
Sure.
We do see a recession still in the horizon.
We're looking at rates that are 5+%.
We see that it is possible for us to get to a 2 to 2.5% inflation rate in 2024.
We've seen consumer spending slow. We've seen business investment slow. What we haven't seen is the type of retrenchment that we typically see ahead of a recession.
I think the economy is going to surprise people by its resilience.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television across America, worldwide. An extraordinary Rationalization Tuesday in the middle of bank earnings, on to Goldman Sachs tomorrow. But far more than that, John, on to the mystery of the rest of American earnings.
I like to go to the 12-month forecast of 12 months ago, Tom. It's where people thought we would be. And we're nowhere close.
Nowhere near it.
We were talking about unemployment going to 4, 5, maybe even higher, 6%. We're still at 3.5%, even with the Fed going from 0 to 550 and maybe even beyond. And TK, with the earnings today, to build on what Mohamed El-Erian was talking about on Friday, it's not about what has happened, it's about what hasn't happened. With the bank earnings 3 months after a crisis for the regional banks, it's just not terrible. And not terrible is so much better than what was expected 3 months back, never mind 12.
I'm going to take it even further and go not only the crisis of the banks a number of months ago, but we're still within the shadow of the pandemic, the dynamics of a consumer. Here's Moynihan talking, I believe it was Moynihan, maybe the CFO, talking about a buoyant American consumer. That's French to a lot of Americans. They don't buy it.
And this is the struggle reading this economy right now. Huge demand pull forward for goods in a pandemic. Push it out for services. Here we are experiencing the pent-up demand for services, travel, cruise lines, airlines, all of that. And then you look at manufacturing. Manufacturing sub 50 and contraction, recession, China not doing great, Europe in recession, Germany specifically. And then you look at services. Services still really robust. And Lisa and myself have been asking this question of guests over the last few weeks. How do you think that converges? Manufacturing up to services or services down to manufacturing? And that's still a debate right now, halfway through 2023.
So we all agree we don't have a clue out 12 months where we are,
no clue.
Like we got wrong 12 months and 24 months ago. Lisa, what's your take on this? What's the development through the summer that you are looking for?
Actually, the tightening in credit. I think that Fed survey is really interesting. On the margins, how difficult is it for people to get loans? How much higher do credit card interest rates go up as some of these banks
extend that? You mentioned autos. They're saying no?
Yeah, there are more people getting answers of no than yes to their applications for auto loans at a time when there are a lot of people who are underwater, who took out loans for cars that were worth substantially more than they are now at a time when you've got the likes of Ford cutting prices.
And John, let me go to you here. Well, we saw the huge F-150 cut yesterday. Ferrari, John, I don't believe they're cutting even on that.
No, I don't think they're cutting prices over at Ferrari.
Note as well, but this goes to the heart of what we've heard from, it was Veronica Citigroup. Help me.
Veronica Clark.
Veronica Clark, thank you. Andrew
Hollenhorst.
Hollenhorst, got it. Nailed
keep
that.
doing this.
They were a good duo. They played
Keene.
Crosby, Stills, Nash like no one. But the answer is Veronica nailed this, and like everyone's waiting for the job market to break. There's no evidence of it.
Veronica's pushing another story too, and it's the reacceleration of inflation in early 24. You can find consensus on Wall Street right now about a soft patch for inflation, disinflation through the summer. The division starts to emerge as you get beyond August and into September and into the fourth quarter after that. And there's a view at Citi that things reaccelerate and pick up again. I mentioned Jim Bianco earlier on today. We've all caught up with him recently. I'll catch up with Jim in a couple of hours' time. Jim believes that disinflation will be transitory. That inflation hasn't topped, it's bottoming. Get your head around that. He thinks that inflation is bottoming for 2023. That's a very different perspective to the popular narrative on Wall Street over the last week.
FHN Financial with a nice pulse on the street. Lisa, to quote exactly moments ago, with the Atlanta Fed's GDP tracking model estimating 2.3% annualized growth, even a big downside miss on this morning's retail sales will be a decent second quarter. That captures it nicely.
This idea of immaculate disinflation, once again, very much in vogue at a time when there still are people saying that the Fed's tightening will have ramifications and that you cannot have your cake and eat it too. This has been one of the big disagreements. If you do get inflation coming under control, can it be painless, Tom?
10-year real yield, it pulls back the disinflation in place off that key statistic, 1.5026. John, a 1.49% 10-year real yields. Jermaine, we're not there yet.
Nominal yield down 5 or 6 basis points if we can get up the board. The bond market looks like this, 3.75 on a 10-year at the moment. The 2-year down 5 or 6 basis points to 4.69. We've been drowning in bank earnings. Don't forget retail sales just around the corner, 25 minutes away. Then the last bank on Wall Street to report, the last big one, Goldman Sachs. That's coming tomorrow. In the FX market, dollar showing some more weakness against the euro for a 9th consecutive session. 112.57 on the euro against the dollar. We're positive there by 0.2%. And equities really not doing much over the last couple of hours, eh? We're down by 0.06% on the S&P.
Katrina Dudley joins us now, running real money at Franklin at Templeton. We're thrilled she could join this morning. How do you adapt and adjust here? We're talking about the mystery out 3 months. Frankly, the mystery out 3 years. How do you adapt here mid-year?
Look, I think we've been of the position for over a year that if we do have a recession, it will be what we've called a little r recession. I think now we're coming to the point where we're calling it the Godot recession because it's a recession that we're all talking about. We're all expecting it to arrive. And all of the data is kind of starting to show us that maybe we won't have that recession. We're talking about the strength of that job market, the fact that unemployment is persistently low, but you also need to offset that by the fact that the job openings, that JOLTS data, is stubbornly high. So there are so many openings for jobs that are just not being filled, which is why we think that unemployment number is going to be sticky and remain low.
So are you saying that you are getting convinced of this idea that we could see inflation get back down to the Fed's 2% target without the pain that Fed Chair Jay Powell was talking about last year in Jackson Hole?
I think that the definition of pain is going to be felt different ways in different parts of the economy. If we have a look at the worker has been under pain for 30 plus years, and now we're starting to see signs that the worker is being taken care of. So I think that they've already taken that pain and they're now starting to come into their real time. If we look at the housing market, the data there on the starts has been positive. So it doesn't suggest that there's more pain to come there. The area where we are seeing numbers slightly weaker is in manufacturing, and that's where the debate is. But if you take a look at the stocks are trading very differently on a short cycle basis from where they have in the past. Industrial short cycles used to track PMIs, and they're not anymore. And that's reflecting the fact that people are looking forward and they're looking at all the positive things that are coming through. And we've talked about them ad nauseum. The industrial landscape is very positive. So even if we have a slight pause in manufacturing, we think by 2024 we're going to be out of the woods.
All right, so then do you lean into this? Do you lean into industrials? Do you lean into financials? Do you lean into all the areas that haven't caught up with big tech this year?
I think you do. I think that you lean into investing. I think that if you are sitting on cash, you're making a call that you expect a recession to come in the second half or maybe the early part of 2024. And we do not see a deep recession that would justify you holding cash. So you need to lean into those parts of the market that haven't rallied as much as technology.
Katrina, you're one of the great voices on European stocks. You've seen the reaffirmation of Nestle, Siemens, all the rest of them as well. When we talk about quality blue chips in America, I think our audience has a real quality. What are the quality blue chips in Europe, and are they cheap to America?
I think you've just mentioned one of the quality blue chip names that we like, which is Siemens, which is an automation franchise. So it's a company that has recently sold off on a lot of those concerns that you're talking about manufacturing. It's also selling off because people are concerned about orders. These are companies that had very, very strong order books. Some of those orders they could not meet because of the short cycle, the supply chain issues that we saw. And so you're looking at a company that's selling off for what we think is the wrong reasons. So if you look over the pond and you look at its peer Rockwell Automation, you can just see the valuation disparity. And we think it's unjustified because we think Siemens, as you say, is a high quality player in the digital industries franchise. And it is the company that you really do need to beat if you're playing in automation.
Katrina, thank you. Katrina Dudley there of Franklin Templeton series on the equity market and the economics of this moment. Here's a note just made for you, TK. What a title from Jim Reed over at Deutsche Bank. The soft landing beverage of choice, referring to the beverage curve and the relationship between unemployment and job vacancies. TK, the soft landing beverage of choice. You like that? You approve?
Mr. Beveridge was a force at LSE, and I would suggest underrated on single-handedly saving the institution. He did so with the Rockefeller Foundation of New York in America. It was going under in the Depression and into World War II. Beveridge has been a piñata within British economics for years, but he came up with this relationship of jobs and welfare. It's something David Blanchflower, as an example, or frankly, Janet Yellen is truly expert in the dynamics on. And the answer is the job market hasn't broken. And the relationship here to something, again, out of LSE, like the Phillips curve, it ain't working. And someone like, say, Jan Hatzius with his recession call, he's out there looking for what's the theory that works, what's the relationship that works. The traditional labor dynamics isn't in play right now.
Well, let's make it really simple, Tom. One of the hopeful objectives of this FOMC, led by Chairman Powell, was to get job openings down without sending unemployment higher. And so far, Bramo, we've managed to reduce job openings to a certain extent. I wouldn't say we've taken a massive chunk out of them, but ultimately unemployment is still in and around 3.5%.
And we continue to see jobless claims come in around 200 to 240, 250,000, and they haven't really sprung upward. So here's the question. Have we been pain-free? Or is, as we just were hearing from Katrina Dudley, are we hearing about pockets of pain in different places, the white-collar recession, the areas where there are layoffs? Is this the rolling kind of downturn that's really keeping a floor under how low things can go?
You know, Mike McKee is great on this. I mean, one thing that's great about Mike McKee to the beverage curve is Mike always has a beverage of his choice in his hand when he talks about the JOLT survey. But the answer is those statistics that we talk about on this show, folks. These talk about the employed America, the people in the game, you know, frictional unemployment, unemployed, worried about unemployment in the job.
Yeah.
There's a whole nother America out there that the politicians have to pay attention to that's really not within the Bloomberg surveillance
Take
dialogue.
a sector right now. We've talked about manufacturing and recession, but service sector, tech sector, let's do tech. It's a big difference between owning tech stocks and working in tech over the last 12 months. Be very clear about that. Some of these major tech firms, we've seen cuts after cuts after cuts, big cuts to the workforce for some of these companies. From New York City this morning, welcome to the program. If you are just joining, on the S&P 500, we are negative by 0.09%. The next stop for this market comes in about 18 minutes' time. It's retail sales in America. And going into it, stocks a bit softer, yields a bit lower. We're down 6 basis points, 374.62. I wonder what would be the soft landing, hopeful, dreamy kind of data point that would drop Lisa in 17 minutes. What would that look like?
A little bit slower with respect to spending, but still robust. That yes, people are buying, but they're pushing back against price increases somewhat. The sort of, happy medium of not too soft, not too hard, Goldilocks. Do we start hearing about that type of scenario again?
Goldilocks, Tom, you approve? Yeah. No.
Well, I mean, what else would be the ideal situation?
TK reading nursery rhymes to you as a kid.
Is that what we descended
not
to?
Too hot,
nursery
not too
rhymes?
cold, and then it was just right.
I can just see.
They all went home. Go to sleep.
Seriously,
my dad, frankly.
Can you see Janet Yellen doing "Goodnight Moon"? Goodnight Moon.
Sing it.
Good night. She'd have a ratio. Good night. The beverage curve. Good night. The Jolt survey.
Is she going to sing it?
No, she wouldn't sing it. It's a children's book, John, in America.
I don't know that.
You don't know Good
Really?
Night?
I have it memorized
Oh,
from when they were younger.
No.
It's a children's.
Is it a good book?
It's an American.
It's
deep.
sweet.
The movie was great.
What?
They made it into a movie.
No, it's like 3 words.
To re-weaponize food in a world where there are massive food shortages and people are going hungry and dying of starvation. I think the Russian action is reprehensible. If this is what Russia is intent on doing, then the rest of the world has got to, take action to make sure that we get grain out.
Mairead McGuinness there, the EU Financial Services Commissioner on Russia, the commodity market. This is how we set up this morning, going into retail sales 13 minutes from now. Equities just a little bit negative. We're down lower, softer by 0.08% on the S&P 500. Just want to take a beat and take a moment to sit on crude. $74 a barrel on WTI. We're positive by 0.4%. Year to date, we're down about 7% on WTI, down about 8% on Brent. Some people got this market right. One of them was Ed Morse of Citi, warning that oil bulls moving back into the market are making a mistake. He wrote this: "The bulls have got it all wrong. The world is still waiting for a real Chinese recovery. Europe is in recession, and we still don't know if the US, Tom, will have a hard landing." Ed Morse pushing back.
Ed Morse is different than the others, and we talk to them all and have an immense respect. For example, the oil microeconomics of Goldman Sachs and Allegiant Global Sense of Bank of America, maybe what we see from Emerita Sen over in London. And then there's Edward Morse. Yeah, he's global head of commodities research at Citigroup, but he does geopolitics and the larger view better than anyone. Dr. Morse joins us this morning. Ed Morse, I'm going to rip up the script here, and you allude to it in your research note. We are having a climate change 2023 globally to beat the ban. Someone as giant as Michael Mann is really, really intense about this is a new climate change. How do you, with all of your expertise, interpret the global warming we're observing?
Well, it certainly has upended a lot of expectations. The world has decided to rely significantly more on solar and wind and on water. And part of the climate change process that we're seeing is disrupting that. The sun is being impacted by wildfires. The rain is not happening in the places that we need it. It's happening where places that we don't want it. And the wind stops blowing at the wrong time. So we are really in a power gen crisis that is global and is not going to stop anytime soon.
What will that do to price of oil and off the price, the supply and demand dynamics?
Well, the price of oil is still essentially that based on a transportation fuel market, not on a power fuel market. Part of the climate change surprise in 2021, reinforced by both climate change and the Russia-Ukraine war in 2022, is that we had a surge in natural gas prices, and it made diesel more expensive because there was fuel switching to beat the ban between natural gas and diesel. So that's the first time that we've seen a spillover effect from the power gen market into the transportation fuel market. And it's not going to be the last time that that's happened. But that separation that we used to think of as automatic is no longer automatic. And when we get into the next crunch on that gas, which might well be in 2024, we might see that happening again. Meanwhile, between the obstacles to invest in fossil fuels and the reduction in demand that we're seeing, that spells volatility ahead. It spells a market which will be moving between supply shortage and supply oversupply on the oil side from year to year. And the oversupply won't be big enough to bring us down to $20, let alone negative prices. And the undersupply won't be big enough to get us over 100. But it will mean volatility in the market is going to be there as we go through decades of an energy transition.
So what's the range then? The band is from $60 to $100 a barrel?
I'd say there's a soft put at around 70 at the moment. That soft put exists not only because we have OPEC, which really doesn't want oil below 70 and are proven to be able to take action, but we have the U.S., which has basically announced that it will be more aggressive about filling the strategic stockpile. When we get to 70, we have China that has, since the 2008-9 great financial crisis, decided to build inventories when prices are low and to use those inventories when prices are high. So I think we have a soft put at the moment, higher than 60 and maybe at the 70 level. On the upper side, you never really know what happens. There are wild cards. Hurricanes are certainly wild cards. All we need is 2, 3, 4, 5 category hurricanes in the Gulf of Mexico, and we get damage like Hurricane Harvey or Rita and Katrina year, where refineries are out for 4, 5, or 6 months. The U.S. is the heart of the global fossil fuel market. The U.S. Gulf Coast is the largest contributor to combined oil and gas in the world.
Yeah.
We are between oil, crude, and petroleum products now seeing 9 or 10 million barrels a day of exports, most of that coming out of the Gulf Coast. And that's larger than the total production of either Russia or Saudi Arabia. And we're seeing 15 BCF a day of natural gas coming out of the U.S. Gulf Coast. Flooding can knock all of that out for a while. So we have that wild card sitting there. But without the wild card, I'm comfortable thinking 90 is a real ceiling for whatever we see on the tightness side of oil for the time being.
Ed, where does a soft landing versus a hard landing fit in from the U.S.? You said we haven't really priced in something of a more honest recession in the U.S., which a lot of people are discounting altogether. What makes you think we shouldn't?
Well, partly because of my colleagues Veronica and Andrew, who you were talking about earlier, and you know, I believe what they say about where economic growth is going, and I tend to believe people like Larry Summers, who are among those pushing for the hard landing scenario. But there's something secular going on as well. We had lower oil demand last year in the United States than we had the year before, and that's by every measure on almost any product other than this category, what we call other. But we had less gasoline demand, we had less diesel demand. We're seeing a pickup in gasoline demand this year because people are taking vacations more than they did last year. But we're not at 2019 levels yet, if we ever will be there again. We're really seeing a phenomenal structural shift, both in gasoline and diesel in the U.S. The diesel side of it is partly related to the efficiency of trucks. More importantly, there are 2 things structurally going on. If you look at, those of us living in New York and looking out on the street and seeing delivery vans, they're mostly fueled by cleaner energy than diesel. They're mostly fueled by either hybrid vehicles or electric vehicles or natural gas vehicles. So that plus the actual drop in trade, we have a lower level of container ship movements since last September. We have onshoring going on in the United States and in Europe to take away from China what has been a significant part of their exports. We're seeing a slowdown in trade, which means a slowdown in trucks going back and forth to ports. Between the change in the fuel stock and the change in the trade environment, that's a really permanent factor in the market. On the gasoline side, one of the biggest issues is, of course, the increase in fuel efficiency. And we didn't expect the increase in fuel efficiency that we've seen, but certainly during 3 years in which we had supply chain problems in the auto industry, auto manufacturers were selling either the most fuel efficient and therefore the most expensive ICE vehicles they had, or selling more electric vehicles. And the fuel efficiency of the U.S. has gone up a lot in the last 3 years. And on top of that, we're having a record amount of retirements. And with that, fewer people with 2 or 3 going to more people with 1 or 2 cars, and they're driving less, even with the labor market statistics. So balancing that are other factors. And I think we're very close to the U.S. joining China and Europe in reaching oil demand, coming sooner than most people expect.
Ed, we've got to leave it there. Fantastic assessment, analysis on the commodity intensiveness of economic growth. Ed Morse there of Citi. 5 minutes away from retail sales in America. Mike McKee and more coming up.
Bloomberg Surveillance. Good morning, everyone. John Farrell getting ready for our next 9 o'clock hour. Mr. Distenfeld will be joining John. That is a good thing as well. Lisa Abramowicz and Tom Keene here with economic data. And Lisa, it's, I guess, disinflation retail sales because it shows retail sales top line in inflation, but maybe there's less inflation, so maybe I'm making this up as I go.
Well, there's some expectation that auto sales will cushion the numbers just a bit because of some sales, but that there won't be the same kind of underlying strength that we've seen in prior readings.
Maybe because with this inflation coming down, we're delaying because Michael McKee is searching for what retail sales will be doing here. But there's a mystery here, Michael, seriously, before you get the numbers, because we're disinflating into these numbers, right?
Yes. I mean, inflation has driven retail sales over the past couple of, last year, basically. The first number comes out, advanced retail sales up only 0.2%. That would be down from 0.3, although I don't have any kind of revision yet. And that is much lower than the 0.5% that was thought. Ex-autos were up 0.2. Now, there was a thought that the feeling going in, according to economists, was that autos were going to drive that bigger headline number, but it appears to be not the case. Take out gas and you're up 0.3. We're still waiting for the control group to come down, but it is not the kind of performance that economists expected. And because we have a slow internet, it's hard to get
let's wait for the numbers. Let me show the markets here right now. Michael, I'll come right back to Michael McKee when we get this important data, because we have a substantial market move with yields lower. 2-year yield bombs down 7 basis points. Big move, 4.67%. 10 years, 3.74%. Lisa, critically here, I had a 1.49 on the 10-year real yield. This is a disinflation half a report so far. We're still waiting for the meat of it.
Right.
With Michael McKee.
Bad news is good news, although we are getting some more data. Mike?
Yeah, the meat is much better. The control group, which takes out gasoline and takes out building materials and autos, is up 0.6. So there's a weakness in one of those three areas that we haven't seen yet, and I'm going to be looking for that while you guys are chatting for just a second.
We're seeing that move lower in yields, Tom, but I do want to pick this out as well, that U.S. May retail sales were revised upward from 0.3% prior read to 0.5%. So even though the headline number came in slightly softer than expected, revisions upwards in the prior month. This is not a clear-cut report, especially with broad-based gains outside of the gas and the auto sector.
Yeah, it's a mystery still. We get the revisions, and here are the revisions. I feel like I'm doing Miss Universe or something.
Yeah.
Continue, Mike.
The numbers for May, the headline number revised up to 0.5, 0.5% from 0.3, and the control group revised up to 0.3 from 0.2, and that comes in at 0.6. I'll give you where the headline fell short. This is much better news than you would have thought. The advance number for gasoline was down in terms of the overall number, 1.4%. And economists had thought that maybe gasoline would add a little bit to this. So that's one of the areas in which we see some weakness. Motor vehicle sales, 0.3 in June of 2002, we were seeing 5% changes. So not a huge change in the motor vehicles area, but we did see declines in health and personal care stores, gasoline stations, as I mentioned, sporting goods and general merchandise stores, department stores down 2.4%. So people pulled back on some spending, but there is still spending out there.
Within the mess of this announcement, no fault of Michael McKee's, it just took a while to get it out in a clumsy way. but we had yields in sharply. Now yields reverse, 10-year yield reverses as well. How does this data, this information, Mike, this late in the quarter fold into the Q2 view?
Well, it will go into the Q2 view, but less than the retail sales report is not a real component of it. The control group is a proxy for retail spending, but remember, this is mostly goods. So it's the personal consumption number that we get at the end of the month that will really be the number that people want to see, because we want to see if services spending went up.
Michael McKee, thank you so much there. And retail sales gyrating and swinging, your 2-year yield was in a full 7 basis points and now is in only 3 basis points after the revised numbers. As confused as we are, but never confused, is Jay Bryson, chief economist at Wells Fargo. Jay, wonderful to have you with us. I think that states the confusion right now. Does Wells Fargo have clarity on what the American consumer is doing?
Clarity, that's a strong word, Tom. But I guess in general, when I stand back and I look at everything here, there has been some deceleration in consumer spending. Consumer spending in the first quarter in real terms grew over 4% annualized. We're just not going to get that in the second quarter. We came into the second quarter with some deceleration. These numbers that Mike just talked about, I mean, on balance, I think they're okay. But in general, it doesn't change the big story that there has been some deceleration in terms of consumer spending out there.
Jay, how much has the overall discussion been completely distorted by the auto sector? How much the prices just shot upwards in the aftermath of the pandemic and now are coming down and resetting, especially as auto loan rates are getting so high? How much is that behind all of the confusion?
Well, Lisa, I wouldn't say it's a huge part of it. I mean, so if you break down consumer spending, roughly 2/3 of consumer spending is going to be on services. And the other third is split roughly equally between non-durable goods. So that would be like clothing and shoes, et cetera. And then durable goods, well, a component of that is autos. So it moves things around on the margin. But again, the big driver of consumer spending growth in the economy is services. And I think that has been, in some sense, more distorting over the last 3 years, in the sense of when the economy was shut down, the service sector was shut down, and then that came roaring back last year as the economy opened up, all this pent-up demand for spending, and a lot of that now is pretty much behind us right now. So we hopefully are getting to the point where things, the aftershocks of the pandemic in terms of the economy are now settling out.
Okay, so the aftershocks are settling out. What is the new economic trajectory when it comes to inflation? Is it back to what we saw previously? Or is it something different, especially if people are getting paid more and they're not pushing back as significantly as some would like with respect to how much prices can keep going up?
Well, I may differ a little bit on that. I mean, I think you are seeing some signs of that right now. I mean, we are seeing it in terms of deceleration, in terms of inflation out there. It's still slowly coming through in the service sector. But if you look at the rate of change over the last 3 months, you're seeing less service sector inflation as well. I mean, our view here is that we are heading back towards 2%. Now, it's not going to be right away. It's going to take a little bit of time. And part of that is predicated on some economic softness, i.e. a mild recession early next year. But, I think these 9-10% sort of numbers that we saw, or even 5%, I think that's a thing of the past. And I think we're heading back towards a 2% sort of era.
Jay, on the international basis here, and after the clumsiness that we see here of American retail analysis, do you have a clue what the Chinese consumer's doing? I mean, we sit there, guys like you have to pontificate and say, yeah, this, but do we really know what the Chinese consumer's doing?
So, we started this with Lisa saying, what's your view with all this noise in the United States? Now square that when you talk with China, and just in terms of the data lapse and gaps, and you got to take it with a grain of salt sort of stuff. But it does seem like, things in China are also kind of slowing down as well. You got this really lousy GDP number the other day, and I think that's going to continue going forward. What we do know is the Chinese consumers are, they still have a very, very high savings rate. They're still very concerned about healthcare. You just don't have the healthcare system in China as you do in many Western sort of countries. And so that keeps the savings rate in China elevated over there.
Jay, to go to micro here, and this is your team under you working on this, including Sarah Hunt, the retail sales control group, X what? X Red Sox tickets, Mike, X building materials, X autos, X this, X that. Do you get value out of a buoyant control group for 60 days, Jay?
There's obviously there's some information in there, Tom, but again, these are nominal sort of numbers, and at the end of the day, what we economists are more concerned about is real, and so you have to deflate that by some things that are in the CPI. And again, as I said earlier, when you look at overall retail spending, it's roughly a third of the U.S. of spending. The big component is the service one. So what we pay much more attention to is the numbers that we're going to get at the end of the month and the personal income and spending. That's when you get the service sector components and you get real numbers as well.
So just putting this all together, are you increasingly in the soft landing camp with this being a soft landing type of retail sales number?
So, Lisa, we've been in the, it depends on what your definition of a hard landing is, but we've been in a recession camp now for about a year. And we've had to push that call increasingly back out. I would say right now, if you hold a gun to my head, you say, what's the probability of a recession in the next 12 months? I would still say it's still roughly 60%. I mean, what's going to happen as we go forward is the inflation is coming down, okay? The Fed, no one thinks the Fed's going to be cutting anytime soon. So what's going to happen in the months coming is you're going to get a passive tightening of monetary policy as the real rate drifts higher and higher. So in order to have a, quote, soft landing here, I think the Fed needs to be still very adept in terms of monetary policy later this year as inflation comes down.
Dr. Bryson, thank you so much for joining us today. Jay Bryson, leading all of economics at Wells Fargo. Your thoughts on this, Lisa? I mean, we're going to have Michael McKee come back here in a bit, but just your thoughts on this in general, the clumsiness of this.
Well, is it just a disinflation that is a good thing, or is it a path towards something that's more pernicious, a real retrenchment in spending? That's the uncertainty. We don't know where we are in that continuum, although a lot of people are doubling down and saying the consumer is still healthy. Balance sheets are still flush with cash, albeit less than they were a year ago. And that's the distinction. People are saying where we are is a normalization that leads to a less painful type of lower inflation statistic.
Let's do a data check here, and let's do it with what matters, and that is that Bitcoin is under 30,000.
Really?
We've had a real stability, 29,820 on Bitcoin. A tough, I'm going to call it 30 hours for Bitcoin. The yield space, higher yields off the shock of the ugly, clumsy rollout of retail data. We had sharply lower yields. Now we do not. The 2-year yield 4.73%, 10-year yield 3.78%. Red on the screen, but nothing inflammatory. The Standard & Poor's down all of 0.1%. We say good morning. Lisa Abramowicz and Tom Keene, John Ferro preparing to drag us into the market. Opening here on television and radio, really looking forward. Howard Ward will join us on radio. I'm really excited to get his equity update, his courage to be in the market. Our ability is to speak to Michael McKee. And Michael, the economist Sam Rowe has out on Twitter a great observation, which you are expert on. Online, up 1.9%. Department stores down 2.4%. That's a ginormous 4 percentage point delta between where we're going and online. How does technology overlay our retail sales? It just seems to me this observation from Sam Rowe of buoyant online department stores flat on their back speaks volumes.
Well, we did see a big shift to online, obviously, during the pandemic, and people are still doing that. There's been some obituaries written for the brick and mortar stores that seem to be, from recent earnings, a little premature. People like to go out and try on clothes and try on shoes and things like that. But it is true that in this latest month, department stores were down significantly, while non-store retailers, the online folks, were up. And department stores have been struggling the past 6 months or 8 months, they aren't seeing the same kind of traffic that people saw.
I think for the American economy, out 12 months, folks, or for that matter, out 12 years, that's an extraordinary trend. Just that across 30 days in June. Futures at -6, Dow futures at -32. The VIX stable, 13.60. Thank you, Ed Morse, for wisdom on climate change. Brent crude, 78.57. This is Bloomberg Surveillance. Good morning.
China has a huge potential, but it's actually still quite a small market for you.
It is still small for us. Yeah, huge short, mid, and long-term potential for us. So it's about 6% of the company today. We're being very deliberate in our approach in China. So we could grow faster, but we want to do it in a quality way. So we're building the brand. So that serves us well 5 years from now, 10 years from now. But I'm very excited about just more generally Asia and China.
Patrice Levette, Ralph Lauren's CEO there, as they continue to look at luxury and the partitions of luxury as well. Good morning to Dana Telsey. I mentioned her earlier, Telsey Advisory Group, with their work on LVMH. There'll be a lot of that coming out as well. We're going to digress here away from the Fed, away from the view from 60,000 feet, and actually talk about what America's doing. Chuck Graham is hugely qualified at Gordon Haskett to talk about this, and he's hugely qualified to know that what you do is you pay attention to what the people at Adobe are doing. Adobe owns a high ground of the micro-analysis of every transaction out of the Abramowicz household. This is a known and beautiful thing. Mr. Graham joins us this morning. On Prime Day, away from all the mathiness of it, Chuck Graham, what was the single message you learned?
I think that the single biggest message is that Target looks like it was a real disappointment on a year-over-year basis. And when we compare visits to other retailers on a multi-year basis, they were really just look like they disappointed. So we're clearly seeing some mean reversion for Target on the sales front. I think that was the biggest takeaway.
As you look just generally at retail sales following the retail print we just got out of the U.S. government, there is a question of whether this is good deceleration in consumer spending or bad deceleration, meaning that they're running out of appetite to buy. Which is it?
Well, we actually are looking at it on a 4-year basis. I know that the headline numbers are on a 1-year basis, but if you really compare it to 2019, the June numbers actually look pretty good. We're talking about over a 300 basis point acceleration relative to the month of May. And we track things across, close to 15 categories, and every single category that we look at actually had an acceleration. So we're actually taking a little bit of a different view. I'm still kind of crunching the numbers that just did, like you said a few minutes ago, but overall they actually look pretty good.
When you say pretty good, is it across the board, or is it just outside of autos where people loaded the boat already? And you strip out that kind of sector and people are spending more in retail. You're seeing that in some of the results. They're spending more certainly on travel. We heard that from Ed Bastian over at Delta.
Yeah. There's no doubt about that. I think, but to your point, earlier in the conversation, digital definitely looks like it's a bright spot. Department stores look like they're a weak spot. Is that new news? Really, no. I think what the interesting takeaway is, if you look at a couple of categories that have been weak over the past 18 months, categories that have been on the downslope of that mean reversion, CE looks like it was a little bit better. Home furnishings was certainly a little bit better. So we're taking a little bit of a more optimistic approach here with the June numbers, and it actually dovetails nicely with, Tom, you mentioned some of the Adobe statistics. We look at a lot of footfall data. Our survey work that we do definitely showed throughout the month of June some uptick relative to the prior, say 2 or 3 months.
Chuck, I know when you were at the College of the Holy Cross, when you were bored stiff, which, at the College of the Holy Cross, Worcester, Massachusetts, you go down Route 9, you go down Flutie Way, you go over to the Natick Mall, and you look at the future of America. Is the Natick Mall or any other ginormous mall the future of America when you look at the mathiness you study of omnichannel? Is omnichannel working?
Oh, it's unequivocally working. And you're seeing more digitally native brands start to open up retail stores, and obviously retail stores have adopted digital. And I know Target's going through a tough patch right now, but during the pandemic, I mean, they really accelerated their online pickup and drive up business. And so it's clearly intermingling of the stores and the digital world that's working and will continue to work, in my opinion. So I think there is a place for malls. Not every mall is going to survive, but the better malls will.
How will Amazon compete with all this? They seem to be winning. I mean, the stock's in recovery, and I get that. And there's a whole sidecar Amazon story of overhiring and that. But what is your perspective on the 14 boxes that show up at Lisa's house every day?
And the 22 that show up on my front porch every day as well. I mean, I think that obviously Amazon's winning. I think what we're more focused on is the brick and mortar guys. And I think a company like Walmart, through its Walmart Plus and Walmart Connect initiatives, is really catching up very quickly. The number of SKUs they're offering, the speed that they're delivering. Right now Walmart's in a really enviable position because people are trading down. More affluent people are shopping with Walmart. And unlike 10 to 15 years ago when Walmart gave most of those customers back, we think they've got a great chance to hold on to that customer base.
To me, there's a new vengeance here, Lisa, with the tensions out there, particularly coming off inflation. People, and particularly up the food chain, they're hyper-focused. One thing in the kitchen, two things in the kitchen, one thing in the bathroom, one thing in the bedroom. They're hyper-focused on where this is going.
Which is exactly what I wanted to ask you about, Chuck. You said that more affluent people are trading down. We did hear from the likes of Richemont, of Louis Vuitton, that basically in the U.S., the luxury consumer is pulling back just a bit. How much is this a persistent trend that's benefiting the Walmarts of the world, but maybe not so the luxury players that had benefited disproportionately over the past year or so?
I think that you're going to continue to see it to a degree. I mean, I think you touched on it earlier that the consumer is generally healthy in this country. Balance sheets are in great shape. People have more savings than they did several years ago. And I think the real inflection here is that real wages, when you strip out inflation, is really starting to see an uptick here over the past few months. And we think that potentially bodes well for the holidays and into 2024. If we start to see this inflation really start to cool, that puts more money into people's pockets across the board, no matter what the income demographic is.
Chuck, got to be quick. Single best buy. Let's go back to Stern Agee, Deutsche Bank, JP Morgan, all the awards you've won over the years. Single best buy.
Over time?
No, I mean right now. Single best buy,
right
moving
now.
out.
Over time, been Costco. I think Walmart's the best name on the board right now, also followed by TJX.
Even Walmart with a 20-plus PE multiple?
I think earnings are about to inflect significantly, but we'd barbell, so I'd take TJX on the other side. I think both names you can make money before the end of the year.
Chuck Grom, valuable. Thank you so much. Chuck Grom, legend. Gordon Haskett here this morning. That's real retail sell-side talk. How much do I hate the phrase omnichannel? The moment I heard it, it's never rung true. What is omnichannel? I mean, I get it, but still,
many channels. I wonder if this also just means that people go to the store, try it on, and then order it online so it comes to their door. I do want to reset just a touch because we are seeing the market reaction as we do get the Bank of America earnings call. And after the earnings have come out, you're looking right now at Morgan Stanley shares that have pulled back and retraced almost all of their gains after several disappointing measures. And you've seen Bank of America also turn slightly negative as people parse through what to expect going forward. Interesting how high the bar was, even with some of the big beats from Bank of America, Tom.
Yeah, maybe they had a little adjustment off the JP Morgan enthusiasm of the other day. But, folks, I've really never said this in umpteen years. The earnings season for banks is barely started. We had Thomas Schode with us at KBW yesterday. And I'm sorry, this is a KBW Sandler O'Neill season. These regional banks and these smaller banks tell us a lot about the linkage here of finance into economics, and I hope ultimately over to Dow 34,727.
I take that point because PNC shares lower by almost 3%. That has been a move that stuck because they brought down some of their expectations for future revenues. And they also saw that bleed of deposits going out, just like you saw that also at the big banks.
I don't have the math in front of me, but again, Bank of America with a great PowerPoint. There's the money that people want to earn on their yield right now, on their cash, and there's what banks are willing to pay. And there's a little, I don't have the numbers here. I'm sorry.
I'll give you some numbers.
Chanel,
Bank of America, total deposits fell by 5% from a year earlier, 2% from the first quarter to $1.9 trillion, not exactly crying for them. Non-interest-bearing deposits fell 24%, while interest-bearing deposits rose 5%. People are sick of not getting paid at a time when you've got a Fed funds rate north of 5%.
There's no question about that. I mean, you see it with the money market funds as well. That hinging, let's say, off the 3-month T-bill, 5.35%. That's stunning, 5.35%. I mean, with any kind of Jim Bianco undisinflation, you get that out near 6% quickly. 2-year yield, 4.70%. A 10-year yield in 5 basis points, 3.75%. Curve noise today in the inversion space, 95 basis points. It's germane. It's something to watch here as we go through the week into the Goldman Sachs earnings tomorrow, and the real yield 1.52%. Much to come up. Goldman Sachs earnings tomorrow, but in between at 1:30 p.m. this afternoon, our Chanel Bassick with James Gorman. He is the leader of Morgan Stanley. That will be most interesting. From New York on radio, on television, this is Bloomberg Surveillance.